recession with economic growth
upside surprises
during this inflation panic.
Just like the UK.
Yeah.
Just like I would say this was about rate differentials more recently. It's been difficult, I agree with you. If you think about where we were last year at the end of September, the Bank of England was needed to be aggressive, but I think there was a financial stability aspect to that, or financial instability aspect to that.
Good point.
There was also the fiscal policy risk around it too. So there was lots of different variables, but certainly over the last few weeks, you've seen sterling strength off the back of a more aggressive Bank of England, and we're fading it for the complete opposite reasons, I guess.
For our American audience right now, a clinic on the United Kingdom and on Europe and on their potential for economic growth. Joining us now is Callum Pickering. He's with Berenberg, their senior economist. And Callum, the metaphor I want to do is your Sheffield United Blades. And years ago, like a decade ago, they ended up buying the Chengdu, China football team. I mean, there's an export from the United Kingdom of capital over to China, I guess, to support global football. How is within Brexit this new Pax Britannica doing? How is the trade dynamic, given all the buffeting inflation and that, how is the UK doing on addressing China, on addressing world trade?
It's a good question. I mean, there's been a huge change in the distribution of trade for the UK. So we've shifted away a little bit from the EU, more towards non-EU trade, but it's not a huge move yet. These are generally things that happen over time, and actually to a large extent, the higher costs of trade through, well, trade barriers, and of course the weaker sterling hasn't shifted things between the UK and the EU quite so much as one might have expected, and as a result, you then haven't had the other side of the trade shift, which is non-EU. Where we've seen a big hit actually is on investment in the case of the UK.
But what are we going to see here? I mean, is Berenberg an optimist here on a Brexit United Kingdom coming out of this inflation, coming out of this pandemic, frankly, the tangential war in Ukraine? I mean, can you be a trade optimist on the United Kingdom?
You can make a positive case for the UK, no question. This is a lightly regulated, open, advanced economy where I think you need to add a little bit of nuance is around what economic strength actually means. The UK is no longer a fast-growing, advanced economy. Because of Brexit, but for a host of reasons, potential growth has slowed decidedly. It's probably around 1.5% now. Before the financial crisis, it was probably 2.5%. However, even though potential growth has slowed, on the balance sheet side of the economy, from bank capital, household savings, the distribution of debt, consumer credit, you can make the same case for businesses. Debt is low, cash is high. The balance sheet of the economy is incredibly strong. And so when it comes to worrying about downside risks, we have to worry much less about that. The UK has gone from a highly geared, fast-growing, advanced economy to an economy with a good balance sheet that no longer grows so quickly. And so it's just much less exciting both ways. We avoided a recession over last winter, despite the pessimism around one. But looking ahead, the recovery will probably be restrained. We aren't going to take off as soon as these headwinds disappear.
Everyone cares very much what's going on in the UK today because, as John has been mentioning, it's dominating the bond market after reporting that CPI in the nation dropped to 7.9% from the earlier read on a year-over-year basis of 8.7%. How similar is the disinflation in the United Kingdom to what we're seeing over in the US?
It's almost the same mechanic with a lag of probably around 6 months for two reasons. First, there's a technical aspect around how energy prices pass through the UK. In addition, UK labour markets, which are very, very tight, seem to have produced a higher wage response. Now, this is the thing that has the market a little bit worried. I think it's unjustified. I think what you have in the case of the UK is exceptionally tight labour markets, which have allowed workers in part to defend this real income shock. And the thing that I'm most focused on is inflation expectations for consumers. Forget about the break-even in markets. Look at consumer surveys. Inflation expectations have come down a lot, almost to normal levels. That tells me households, workers are bargaining their wages up because of past inflation, not because of future inflation expectations. And therefore, as inflation falls, because of the sources of inflation start to ease, that's energy, it's too easy monetary and fiscal policy in 2021, what you'll find is wages start to come down. So I don't see any evidence yet that this wage price spiral is forming. And the good news today is that it will help the Bank of England pause with rates a little bit earlier than the market wanted, which will allow the UK to avoid a hard landing.
To take this a step further, Robin Brooks of the IIF pointed out that really all we're seeing with this inflation is the post-COVID normalization. This has nothing to do with tightening monetary policy, which he says has not made its way through the financial system yet in any kind of meaningful way. Do you agree with that? And if so, what does that mean for when some of the rate hikes do take effect?
Well, that's actually part of the argument that the Bank of England needs to stop soon. Best guess would be about half of the tightening done so far has actually passed through into the real economy, so the other half is to come. And we're already seeing a big disinflationary fundamental emerge in the case of the UK. So if the Bank of England just stopped now, which it won't, but if it did, there's still more tightening to come. I wouldn't be in the camp that said this is just all to do with the post-pandemic unwind. There is definitely an element of monetary policy in there, and where you see that, for instance, is in housing markets and in real assets, which have turned down. You get the negative impact on economic activity directly because there's less housing activity, but also on consumer demand as a result of things like net wealth effects. So if you look hard enough, you can spot the monetary effects.
Caleb, is this a recovery out of the pandemic in Europe and in your United Kingdom of the elite? Is this a recovery where we're leaving half the population behind?
It's certainly true that the best-in-class parts of economies always do well first. So London, Southeast, Paris region. But curiously enough, what we haven't seen in Europe is a big gap, say, between Northwest European economies, so the big three, France, Germany, UK, throw in Benelux in there, and peripheral Europe, which is typically left behind. Actually, compared to the pre-pandemic level of GDP, Italy is above the UK, France, and Germany. So you don't get that gap between North and South anymore. That's a curious development.
An unfair question, but you're so good at this, I'm going to go there. What is the best euro value for Germany right now? Slowdown in manufacturing, hugely dominant. We all know the story. What euro level does Germany desire?
Actually, it doesn't really matter for Germany, and I know this is a non-consensus view, but the quality of German products mean basically demand is quite inelastic, and they're so specialized in many ways. There's not much competition for the products that are made, which means if the world is doing well, you want expensive German quality manufacturing products. That pushes the euro up. So in normal times, a strong euro is probably a signal, actually, that there's decent demand for products out of these manufacturing-oriented economies. On the downside, when the euro is weak, yes, it may provide a little bit of relief, but ask why the euro is weak. It's generally because the world is not in good shape. And so I'd rather have the strong euro and the minor headwind than the weak euro and the big headwind.
Hey, Callum, thank you. Callum Pickering there of Berenberg on the latest economic data out of the UK and worldwide for that matter. Here's the latest news coming from Carvana, online platform, Tom, to buy used cars. I'm sure you've had a look there. I know you were going to ask what on earth is Carvana.
I knew it.
I know. Two pieces of news here. The earnings is one, but there's a debt restructuring here as well. So let's talk about the debt restructuring, extending maturities and coming to some kind of pact with several firms, including PIMCO and Apollo. The pact cuts over 83% of 25 and 27 note maturities and cuts interest expenses by more than $430 million a year for the next 2 years, apparently, according to the latest information. Carvana up in the pre-market by close to 7%. If you want the earnings, second quarter loss per share, 55 cents. The estimate was 112. So a little bit better there as well, Lisa, on that front too.
Carvana was a darling of the pandemic, and then it absolutely got decimated with this question around used cars and whether they were going to have the same kind of traction. And now all of a sudden they're reporting that they are creating some actual cash flow, albeit still a loss, but they have a pathway to profitability. To me, the interesting thing was they pulled forward these earnings from August 3rd. They made the surprise announcement yesterday, perhaps because they got this pact together with the debt holders, and everyone assumed the worst, and the shares tanked, and now people are rethinking that.
Restructuring the debt, TK, extended maturities.
Well, you get 83% debt. You look at the weighted average cost of capital screen on Bloomberg. WACC, for those keeping score at home, And I just, is Lisa, you absolutely nailed, and of course this is something I'm nutso about, what's the profit proposition? You know, on the back of an envelope, on the back of a cocktail napkin at a bar, what's the profit proposition of something like Carvana other than moving deck chairs and financial engineering?
Well, so
I just don't get it.
they're an online-based used car sales platform, and they offer to come and get your car and buy your car and deliver it to you. And part of the issue is that other car companies and dealerships do this as well. They are online and they will offer the same services. So to your point, there was a chunk of time where people were saying, where do they distinguish themselves? And now they're cutting their debt and trying to create a new platform, which is the reason why you're seeing such massive fluctuations with anything that's positive, creating a massive pop in the shares.
Let's get a 5-year chart on the screen, and we'll talk about that massive pop on the shares. You know what this chart looks like.
I know exactly where we're going with this.
Pandemic, darling. TK, look at this.
Nice.
Look at this. I mean, come on. We're down by something like, what have we got? 89% after yesterday's close, based on where we were back in 2021.
That's why I said
I'm uninformed. Dumb question. Is this a meme stock?
It was.
It was a meme
People
stock.
were saying, but how much are we seeing increasingly? The bar is just so low and the share prices are just so low that any positive news will create a very big percentage pop, at least. Right now we're seeing a 20% pop, which you'll say doesn't really matter when you're coming off a base of one,
Sure.
but you know, that's the kind of response we're getting.
It would be unfair to characterize this morning's move as a meme stock move, though, Tom. I wouldn't
Correct.
go that far. I mean, this
Fair.
is a real restructuring with real players.
Man City's playing Sheffield United in late August. I mean, that's got to be Joe
You
Elliott's
want to
going to show up.
make a flight over and watch
Callum Pickering, Def
make that
Leppard
happen.
together.
And that had to do with Carvana.
Is Callum going to get us tickets?
Ca-
This is all he wanted
he's
to talk
talking
about.
to Joe
to
Elliott.
drive Carvana over to the show.
Carvana just got in the way.
It's a Dow component.
Carvana just got in the way.
100%.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I think the investors sensibly look past what's been going on in the market recently. Deals will get done, companies will go public, people will trade. So I think the market sensibly looked at the big picture items and said, yeah, the rest of the stuff will just come, and that's why we're trading the way we're trading. It was a great, clean quarter.
Things are going to get better for the investment bank. James Gorman, Morgan Stanley Chairman, CEO, in conversation with Sonali Basak yesterday afternoon. A little bit later this morning, in about 44 minutes from now, earnings from Goldman Sachs. Sonali will break that down for you. Let's break down the price action this morning. Equities drifting a little bit higher on the S&P 500 by 0.03%. Emphasis, of course, on a little bit. In the bond market, yields are lower. Treasuries rallying again. We're down 3 basis points on a 10-year, 375.41. Downside surprise on inflation in the UK, sparking a big rally in the gilt gilt market. Your 10-year gilt down 18 basis points. Your 2-year down 26. Off the back of that, a bit of dollar strength against some sterling weakness. 129.26 on cable. On the euro against the dollar, 112.19. We're negative there by 0.1%. We snapped that winning streak on a euro in yesterday's session. Want to get to Western Alliance. Here's a name we talked about a ton over the last 3 months. Western Alliance out with numbers yesterday afternoon. The stock's down about 2%. The good news, deposits are coming back. The bad news, it's costing them big time. Interest expenses up 25% from the first quarter. So TK, you can attract the money, you just got to pay up for it.
We're going to have to see on that. Let's get right to it. We had Thomas Michaud with us the other day of Keefe, Bruyette & Woods, a Stifel company. And the Keefe Bruyette Index is what people like Herman Chan watch. He's senior analyst for U.S. regional banks at Bloomberg Intelligence. He has been the foundation of Bloomberg's surveillance bank analysis, I should say, since I think it was March, whatever it was, St. Patrick's Day, where the world blew up. What did you learn yesterday from Western Alliance?
So what we saw was return to a bit more normal circumstances. Deposits are coming back, which is great and actually better than analysts had expected. But they are paying up for deposits. The good news is that they're actually reducing some higher cost wholesale borrowings as well. So you could see margin expansion going forward in the back half of this year. Loan growth is pretty solid, and you're seeing capital increase as well. So they are taking tangible steps to return to a bit more normal pattern.
And then interest margins getting crushed?
It did disappoint a bit because of some higher cost deposits, as you mentioned earlier, but the expectation is that the margin should expand a bit going forward.
We were wondering about their ability or inability to finance the economy, not just them, but a whole bunch of regional banks. You mentioned loan growth. Can you just walk us through what it looks like across all the regionals right now?
Right.
We understand deposits and that profile of things is better. We also understand they've got to pay up to do that. What about lending? Have they pulled back?
It's been a bit tepid. I would agree with you. Things are a bit soft both on the demand side and credit availability. The banks have talked about pulling back in certain areas. Citizens have talked about getting out of auto lending. Comerica, another regional that I cover, talked about getting out of lending to mortgage companies. So they're pulling back on the margins, and also they've talked about commercial borrowers, the business borrowers. They're a bit more cautious going forward as well. So there is both suppression of both the supply side and demand side.
So what's the business case going forward for how they're going to get an edge, especially versus the behemoths that are firing on all cylinders and delivering massive returns?
Right. So that's a good question. What we're seeing now is that the regionals are playing in a bit more defensive mindset. So pulling back on lending, shoring up their capital base, trying to support their deposits. So it's going to be a bit of a tough slog because you're seeing tougher capital requirements, tougher liquidity requirements, struggles on the top line. So it's going to take a bit of a time to get through this current phase.
As we were talking about earlier, this idea that they are getting deposits, but they're having to pay up for them. Citizens Financial did come out. Those shares lower about 2% in pre-market trading after basically having the same thing. U.S. Bancorp just coming out. Net interest margin basically in line, a little light, but total average deposits slightly under the estimate of $500 billion, of $497. At what point won't it be worth it to keep paying up for deposits just to prove that they're not failing?
Right. So at this point, I think you can see across the industry that deposits have been pretty stable for the regionals. One of the reasons why you may see some slower deposit growth going forward is that the banks are pulling back on lending. So there's a higher bar for profitable lending going forward, given the fact that the marginal cost of deposits is, almost 5% at this point, right? So being able to deliver profitable growth is a struggle, and so that's why you're seeing a bit of a pullback.
God, you're negative. Herman, I'm looking here at what the tone that you're giving us. And there's only two ways to cut this. And the major question is, will a given bank be a smaller bank in the future? And the other side is, when in God's name are these people put out of their misery? Keefe, Bruyette & Woods, 30-year total return under 7% per year. That is mediocrity defined.
Right.
When do they merge themselves out of pain, or does everybody just become teens weens compared to J.P. Morgan?
Yeah, you would expect to see some merger and consolidation over time. It's going to be, there are a few factors that are involved, right? Because number one, the regulators and the Biden administration have been a bit more cautious on bank tie-ups over the past couple years.
They would block two itty-bitty, relatively itty-bitty banks from merging right now.
It seems like the tone has eased a bit, given the fact of what happened in March and April, but it still remains to be seen. The second issue is that there's a bit of a balance sheet issue because of the way rates have risen, and you have to mark the balance sheet, so that could create some hits as well.
That's where explain that. That's really important here.
Right.
Everybody's got fiction on their balance sheet now because it's priced down, yield up. That's not pretty, but if you mate, then you've got to show that loss.
Right. So you mark to market the balance sheet of your target, so that could create a tangible book value hit.
Look at White-Fried Sandy.
Figured it out.
Surveillance, pretty good.
You say he sounds negative.
1/3 of our audience just turned
He
off.
covers the regionals. Is he meant to sound positive?
I don't get it. I mentioned this to Thomas Show the other day. I had Bank X. I didn't mention who it was. I have no idea why they're in business other than for the executives to go to lunch.
That's negative.
No idea.
You said he sounded negative.
Seriously.
Yeah, he sounds negative.
What do you sound like?
I'm just a font of joy.
Armageddon.
I mean, it seems to me they've got the political support to stay in business as well.
Right.
There seems to be a massive effort to make sure that we maintain these regional banks.
Right.
What do you think the regulatory backdrop is going to look like in the years to come?
Right. So it's going to be tougher. We've heard from the Federal Reserve and Michael Barr in terms of a blueprint for higher capital requirements. There's going to be more down the road as well because he alluded to tougher liquidity requirements and other areas like executive compensation as well. So it's just going to be tougher across the board. So that's something that the banks will need to manage across.
Just to sort of tie this all together, are you more negative on the sector after seeing some of the initial earnings than you were a couple of weeks ago?
At this point, things are actually just moving as expected. We're seeing a drip in net interest income in the top line. The balance sheets are pretty stable. Deposits are coming back or stabilizing. You're just in this phase of the cycle where you could see some asset quality deterioration, which we're seeing a bit from banks like Western Alliance and Citizens. So things are steadying, but there are some challenges going forward.
You see it in the provision for credit losses this morning from US Bank Corp as well, 821 million, the estimate for 37. Herman Chan of Bloomberg Intelligence, thank you, sir. Tom, you get the feeling that we just started a process back in March, April, that maybe the drama for now at least, and you can make your own call on that, is over. But ultimately to attract deposits is costing more. And you can see from bank to bank, and I think Herman did a great job of that, just how many banks need to pull back in certain areas of financing this economy.
We didn't touch on it, but the next time Mr. Chan's on, we've got to look also at the politics of this. If the Republicans take the high ground in different parts of Congress or the presidency 1, 2, 3, 5 years out, how does that change the dialogue? Because to a great extent, the Republicans want that diversity of banks out there, profitable or less profitable.
Don't you think the Democrats want the same thing?
Yes.
Want to maintain this sort of regional network of banks?
You're becoming very American.
Thanks,
That's
Tom.
very good.
Well, I've lived here a long time.
That.
He also talked about it.
Yeah, you
Just
nailed it.
saying.
You nailed it. Yeah, I don't think
This
the
year
Democrats
18K.
want. The Democrats don't want.
My 8th year
I'm
in this
counting.
country.
I don't think the
talks
Democrats.
about me like I'm this foreign, foreign alien.
Right off the boat.
John,
he just came
I'm
over.
looking. John, speaking.
Please, he doesn't work at passport control.
How far is Sheffield?
Oh no, yes, he's
Honestly.
going to.
How far is Sheffield from London?
I would say, at a guess, I would say 4-hour drive.
But on the train, we can go. You and I can go Sheffield, Man U in October.
You want to go and watch that?
I don't know. You tell me. I have no clue.
I can find us a better game to watch.
I just want to hang out with Jeff
Sheffield,
Leonard.
Manchester United. Do you think they're going to the game?
Oh yeah, Joe will go.
Okay. Herman, thank you.
Thank you.
Appreciate it. Anna Han of Wells Fargo on a stock market coming up shortly. Your equity market right now on the S&P, positive 0.04%. Next hour, Goldman Sachs.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Fed is doing the job.
The market is very excited around policy rates peaking.
The question is there even more to go? I think there is if the rally becomes broader.
The next 6 months, we're expecting inflation to come down.
We hopefully are getting to the point where the aftershocks of the pandemic in terms of the economy are now settling out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Wrapping up earnings on Wall Street, Goldman Sachs this hour, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market, the S&P on a two-day winning streak this morning, positive by 0.06%. We round things out with Mr. Solomon, TK, at Goldman Sachs in about 30 minutes.
I think this is a bigger deal than normal. I don't know what to expect. I think from the media I've seen, everyone has a mystery upon us, including Srinath Rajan. Shonali Basak will give us the details. So I look for a bombshell. I'm not wise enough to know that. But how do they respond off what we saw with Morgan Stanley? Wasn't Morgan Stanley down during the show? And then at some point, boom.
James Goldman, in that interview with Shonali, Tom, yesterday afternoon, basically saying worse might be over for the investment bank. And he talked about the arc of the quarter, started with some uncertainty, Lisa, and then towards the end of it, got better.
And that seems to be the theme of things were better than expected and continue to improve. And maybe we've turned the corner in an economy that everyone had basically said was going into a recession. The big read from all of the banks has been the economy is not in recession, doesn't look like it's going into recession anytime soon. And oh yeah, by the way, consumers are still retail spending. Goldman Sachs will be more on the investment banking side, but how much of a tell is this for the rest of earnings week?
You've talked about it, Lisa, brilliantly over the last few months. There is a clear divide between the regionals and the big players. Tom, we talked about Western Alliance a lot already this morning, but the other players too. They're attracting the deposits, good news. It's costing them more, bad news, and that was widely anticipated.
Anticipated, and as we've seen, it's come out pretty good. I'm really interested to see what everybody's summed earnings numbers do. I as a rule, I don't really follow like 200 or 210 or 215 or we're down to 190. But I'm really interested to see how earnings pull back.
I just can't get away. Can't wait to get away from the earnings on Wall Street, TK. I've never liked it. Much prefer the earnings from Silicon Valley and tech. They wait until after the close.
Fixation.
They wait until after the close.
That's why you like them
It's
better.
a lot more relaxing. You know, you don't have to sit in the morning just going through a bunch of
I agree.
numbers. That does nothing for me. It doesn't. Netflix
So it's a
a little bit
timing
later.
issue.
It's timing.
It's
just
not-
don't
it's
like
not
it.
substance.
Yeah, just do it after 4:30.
Can I talk about the sign of the times?
Go on.
This is from the Twitter feed. I find it very valuable. The Twitter feed is Bar Chat, and it's the world's first ETF to offer 100% protection against losses, not including management and transaction fees, launched today in the U.S. This is Steve Johnson writing it up in the FT. The headline: first ETF with 100% protection against equity losses. John?
Can you explain that?
No, I can't. And folks, this is the joke of the triple leveraged all cash fund. I mean, it's not a joke now. Somebody's actually doing this.
Okay. They got that idea from you.
I don't know. I want my royalty. But the bottom line is first ETF with 100% protection against losses. Does that scream bull market?
I need to read that story. I can't make sense of that.
Thank you, Bar Chat.
Send me the link, all right? Bar Chat out on Twitter.
Yeah,
that sounds like Bar Chat. I need to read that.
They're good. They were not
I need to
over
get
in
my head around
threads.
that. Okay. Equities right now in the S&P positive by 0.04%. Lisa's going to give you the guide for the day ahead, the morning ahead in just a moment. Let's look back. UK inflation out earlier this morning. Downside surprise. You can just look at the chart. Yields bang down by 3 basis points on a 10-year, 375. Over in the UK, we're down 26 basis points at the front end of the curve off the back of this. So sterling weakness as you start to pair some rate hike bets back at the Bank of England and some dollar strength against the euro too. The euro against the dollar, 112.16 with negative 0.1%. Sterling, they call it cable, the pound against the US dollar, 129.15. Opened up at 130 this morning, Lisa, and we are down 0.9%.
It's been really interesting to see some of the disinflation. As you've been mentioning, bank earnings do finish up today in about a half an hour with Goldman Sachs coming out. Very curious to see how they view investment banking, especially piggybacking on Morgan Stanley. We also are hearing from the regionals. We've heard from M&T, Citizens Financial. We're going to hear from Zions. The banking index of the S&P 500 back to levels that we haven't seen since March, but still a long way to go since they were pre some of the concerns in March that percolated out later. We also get other earnings today. 20 S&P companies are reporting 4% of market capitalization of the S&P. We did get Carvana. That was a positive surprise. Those shares up 17%. We're also going to be hearing from Netflix, Tesla, and IBM after the bell. And at 8:30 a.m., we get U.S. building permits and housing starts. Last month, we saw a massive spike upward in housing starts. A lot of people are saying that's going to normalize, but still the feeling is in the housing sector, we're seeing a rebound from the lows, talking about a rolling recession. Maybe it's over in the housing market, even though potentially we haven't hit the peak in interest rates.
Anecdotally, what do you see in housing? The walk-up I'm in, it's like a rental frenzy. I mean, there's people out in the street waiting to get in.
Are you asking Lisa or me?
Both of you. What do you see in the market?
Well, I think each market
There's no slowdown.
There are different markets. New York City market is different from some of the Sun Belt markets that are slowing down. When you put it together on an aggregate level, rents are going down, prices are not. And that is sort of the dichotomy at the moment.
Headline out of China, vowing to boost private economy and protect business as well. This is about boosting the private sector, not just helping out state firms. They say private companies to be treated the same with state firms, looking to optimize conditions for the private economy. The data just has not been great in China over the last few months, and then that was capped off by the recent GDP numbers that we've had in the last couple of days, Tom.
And it filters into this unique fixation and need on property investment. When do they start really overtly bailing out property. And I wouldn't look just at, the three cities. I'd go over to Chengdu where Sheffield United has a team. And, it goes across China as well. It's going to have to be, but we're going to see, I think we're going to see a lot of this coming up. It's domestic.
Let's see if we get some proper stimulus out of that country. Anna Han joined us now, equity strategist over at Wells Fargo. Anna, good morning to you. Great to have you with us here in New York. Let's start with this. You were looking for a 10% move, a 10% correction. You threw in the towel on that over the last month. What's gone right for you and the team?
Well, I'd say one of our biggest calls being tied to that AI trend. One of our largest calls coming to this year, media and entertainment. And that's actually kept up with the tech sector, if not outperformed it. I think that call we came in because we wanted to see that pivot of spending from really the durable goods into something more services, a little more of that away from home trade. But at the same time, you see this kind of network and cable, these media groups still having that pull. We thought that might be that sweet balance. That was one of our largest calls. And right now, as we see it, we've stepped off that pullback call. Well, we'll throw in the towel, we'll admit ourselves on that one. But something we're still watching here is, what is going to be the pace of this rally in the back half this year? And can this AI and really Uber top-led rally continue? I think that's what's really weighing on people's minds.
Your mathiness informs your research note. I'm fascinated what you think about what revenues are going to do, made up of unit and price, and the calculus jargon here is the partial differentials of units and revenues. How do you see that playing out over the next year?
No, that's very important, right? When you have this top line figure, it's important to figure if that is declining, how much can margins really increase to make up for it? And if it doesn't, then what about prices versus volumes? We've seen volumes declining. If those volumes are declining and price elasticity returns to normal, then what happens to that bottom line? These margins continue to be pressured, continue to be compressed. But so far, the market seems to look through those things. Perhaps they're trading already on next year's earnings or expectations. What we've seen is not just the one and done, but what if we get rate cuts? That easing also trickles into investors' minds and helps look at equity valuations above what perhaps we expected.
So do earnings matter? Or do you just basically look at what the returns have been and then just say, we're going to keep buying because everybody else is?
That momentum trade is always interesting. Do we stay on the train? Who's going to be the first to leave the party? But no one wants to be the last. I think with earnings, the more important is directional than really the figure. Like Tom mentioned earlier, is it 200? Is it 210? What is it? But it's more the sentiment of how much contraction are we seeing, if it's going to be light enough for investors to look through, and really what is driving it. Is it the consumer in dire need or pulling back sharply? That's not what we're hearing. Even with bank earnings early in the season, we see that consumer still remains resilient, wages remains resilient, labor markets are supporting that, but that general slowing tells us things are cooling a bit. But if the Fed is able to give us that Goldilocks, almost that Powell put in terms of not just equities, but really economic consumer spending, then that's a kind of a happy scenario for a lot of people.
It's a confusing market for people who are trying to look at facts and extrapolate out some sort of price target. From your vantage point, how bullish can you get just with a momentum trade, even as you see some of the earnings come in softer than you'd like to see?
Well, the momentum trade actually has been flipping a little. What we've seen was market leaders, and you're seeing the momentum factor, the top leaders, aside from those AI names, have actually started to rotate. And that rotation can also bring a little churn and volatility. So when we think about how long the market can ride on momentum, quite long, no doubt. But what leads that momentum, who those momentum leaders are, I think that continues to have some mean reversion to it. And that's what we use to look at technicals and think about where we want to position.
Shine a light on your client conversations if you can. Do you sense capitulation after the last couple of weeks?
I don't think we're sensing that just yet. I think right now, the beginning of this year burned a lot of people. A lot of people came in more conservative. You were mentioning that ETF earlier. We're worried about protecting against losses. People were happy to take 4%, 5% in some sort of a bond investment, and now they've missed out on 20% in the first half of this year. So that kind of mentality, I think they have to remain strong the rest of this year. But in what underweight names have been most painful, that's going to be the hard part, is when do they capitulate on that? And we have not seen that quite yet.
This is what Lisa's getting at, really. If you've sat on cash and you've missed out on this rally and you feel foolish, are you chasing the winners, big tech, or are you going to places where you haven't seen the gains? When you have those conversations, what do they sound like?
You know, I will say, you know, we're not bringing out the tissue boxes just yet. It's not full tears, but it is a difficult conversation. You want to be, thank you. You want to be chasing in some ways. You really believe that I've got to make up for this. I've got to get back on this train. At the same time, when that train's left, look for growth opportunities in other parts of the market, some place where maybe valuations are a little more friendly. And if we do get this growing belief that we're one and done.
Where's a friendly valuation out there? Enlighten me. Where's a friendly valuation?
Well, we can look for actual sustained growth. Autos? I think autos, given the economy we expect in the slowdown, that's a little bit of a hard sell for people.
Just busted your shot. I thought you were going to say Carvana.
Well,
friendly valuations in Carvana this morning.
Walmart's trading at 24 times earnings. That's nuts.
Is that friendly?
I don't know. I've never seen it. That's absolutely nuts.
Anna, thank you. Wonderful as always. Anna Han there of Wells Fargo. They were looking for a 10% correction. They backed away from that in the last month. We're looking for some more earnings a little bit later on this afternoon, this time from Netflix. Going into all of that, equity futures at the moment look like this. Welcome to the program. If you are just joining, we are positive by 0.01%. Looking out for those Netflix earnings a little bit later. We'll get the views of Victoria Fernandez across Mark in the next hour. Looking forward to that conversation. Netflix year to date up 61%. Cracking down on password sharing. We understand that that's leading, Tom, to more sign-ups. I just wonder what the net figure looks like. How many people just cancelled and said...
Yeah, I'll go there. All I know, my anecdote is it's the only thing at home that's used besides YouTube. I mean, Netflix gets a lot of lift in it, the Keen household. And I mean, the others, Peacock, didn't they raise prices yesterday?
I have Peacock for one reason only.
Yeah.
Premier League football.
I won't do it. I'll listen on the BBC radio. Yeah.
It's that each particular service caters to a different demographic. Peacock raised its prices by $1. Netflix is catering to the teenager and the preteen. That is my sense, based on some of the programming that is coming out and the series that are must-watch that everyone's talking about.
Wednesday is outstanding.
I mean, it's a whole host of them, and they're addicted, and it's just a problem. But you know, this is the reason why.
That feels like home life. Was that the description?
No. It was not personal in any way, shape, or form.
Not at all.
Not at all.
You see how expensive Hulu is now? Whoa. Like in the 80s or something like that. To have the whole
ridiculous.
package, it's just gone.
It's
gone nuts.
Somebody had a great, they just have to raise prices to find profitability. Good luck with that.
Now you've got these strikes, these writing strikes. I'm going to speak to an analyst a little bit later who thinks Netflix is actually best positioned.
We need to go to LA to cover that
because of the catalogue they've already got ready to unveil. We'll talk about interesting things later.
Well, that's good.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges.
So was elected. Was going to keep bringing World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I guess under a Biden administration, Biden America, you'd expect this. If you notice recently, President Trump went up in the polls and was actually surpassing President Biden for re-election. So what do they do now? Weaponize government to go after their number one opponent.
Speaker of the House, Kevin McCarthy. We'll get a view on that from Washington, D.C. with Anne-Marie in just a moment. Let's turn to what's happening in this market at the moment. We are moments away from numbers from Goldman Sachs, 13 minutes away from those earnings. Equities going into it just slightly negative now by 0.02%. I think we can call this unchanged through the morning so far. In the bond market, huge rally, nothing unchanged about it. In the gilt market in the UK, yields aggressively lower, following softer than expected inflation, in the US last week. So that's good news, I guess, if you're bullish bonds. We're down another 2 basis points in the Treasury market, 376.39. Bit of dollar strength out there against the euro, much more so against the pound. The euro against the dollar clinging on to 112. Sterling clinging on to 129. Opened up at 130.36. We are down by 0.9%. We are back down to 129.14 on the pound.
UK gilts came in.
Aggressively.
I don't
Yields down
follow
hard.
it, but I thought of you when I saw that. They really
Thank you for thinking of me
Yield
when you
down.
see the gilt market.
That's once a year.
I appreciate that. Thank you.
Thank you.
Thanks.
But they moved. That's all there is to it.
Warms my heart that you got in this morning and thought of me as you look through the Bloomberg. That's beautiful.
It's
Thanks.
good. Mixed market, Dow up 33
Particularly when it was
points.
rallying too. That meant a lot. Thanks.
Yeah, thank you. Joining us now to save the show, Anne-Marie Horton. She's Bloomberg Washington correspondent, the star of Balance of Power as well. I am fascinated, Anne-Marie, what you're going to say to Governor Christie this evening. I heard the Speaker of the House there, and I get the ballet. I read it with Bloomberg. I read it New York Times, Washington Post. How do you treat a Chris Christie on set tonight?
I think you treat him like a candidate. I think he's really obviously wants to have this lane where he is one of the few that really goes directly after the former president. We know that about him, but I think it's also important to make sure we're getting his take on a number of important issues that you would ask any presidential candidate, not just what he thinks about the former president. I think what was so astonishing yesterday was that there was supposed to be this huge reset for the DeSantis camp. They were doing a sit-down interview with a non-conservative network, and yet the first few minutes of that interview was dominated by the former president. He just continues to really take the oxygen out of the room, and it's very hard for other people to, one, talk about the policies they would want to enact if they were elected to become president of the United States. So I think it's very interesting to also not just get everyone's take on how they feel about the former president, but also how they feel about a range of issues that are top of mind of the American people.
So do they want him on that debate stage next month or not?
That's a great question. I think the American people probably want it because they'd like to see exactly how Trump would interact with a lot of these individuals. You definitely, I think, Governor Chris Christie wants it. I think he's looked directly into the camera on a number of networks saying, don't be a coward and show up. But potentially, the former president could just, again, take the oxygen right out of that debate stage and make it all about himself. And that it means that others struggle to really talk about substantive issues. It's an interesting one. The issue, of course, becomes if he doesn't join the debate, how would he distract from the debate? Because everyone says, even if he's not on that stage, he will do something else. And potentially there's, this worry about counter-programming.
How much is the sort of message of the former president's resonating continually? How much is his support among the population of Republicans continuing to hold strong and to suck the oxygen out of the room, regardless of any allegations or charges?
It's the base. The base continues to stay with him. They will not leave him. And that is the stronghold he has on the party. I mean, this is very much so what we talked about yesterday regarding 2016. The former president was able to win a plurality. he was able to maintain a stronghold on the base, which is why you hear a lot of individuals like Governor Sununu of New Hampshire come out and say, what is so important as we gear up for 2024 is, sure, everyone can jump in now, put their hat in the ring, but is it important to know when to exit, when to leave the stage, and when to throw your support by someone else. So the remainder of them could potentially oust Trump if they're able to coalesce around another individual, and then it doesn't become a plurality again. But this is something the Republican Party is obviously struggling with at the moment, and especially happens when the news just continues to dominate around the former president. Yesterday, of course, was the target letter he said he had received. So that just means we're going to be focusing on another potential indictment.
Should we be focusing more on President Biden and potential competitors with him within the Democratic Party? We have seen at least one much discredited, but there is a question around his popularity, his lack of ability to really draw in younger voters at a time when, this is getting to be a competitive race.
So at the moment, Democrats are still coalescing around Biden. They maintain that he is their candidate, even if, there are whispers or under their breath, there are concerns about what you see show up in poll after poll, which is a concern about the current president's age. By the end of a second term, he would be 86. There's also concerns in the Republican Party as well about the age of their current front runner when you look at the candidates, former President Trump, and his older age as well. The thing with Biden is that, yes, there's RFK, but many just shrug him off as not a real challenger. The potential issue for the Democrats would be if the no labels camp really starts to pick up. And you had Senator Joe Manchin up in New Hampshire kicking that off and basically flirting with potentially what would be this third-party run of 2024. At the moment, it does seem like he's just flirting with it. But when you read the stuff from PIMCO, Libby Cantrell, or Greg Vallier, everyone continues to say that if a no labels, a third party, was to get into this race, the votes would take away from the Democrats. They would hurt the Democrats. They would hurt Biden more so than they would hurt a Republican Party. So I think that is potentially one of the real challenges that the Democrats and Biden could face, less so from within the Democratic Party.
Anne-Marie, completely unfair question, but let's go there. Ticket to Friday into the weekend, what will you be watching for from the Trump camp? I mean, does he need more attorneys, different attorneys? Does he need to put a cork in his mouth or not? What's the thing you're looking for with all your reading on this?
I'm definitely not in a position to give the former president legal advice on whether or not he needs more attorneys or better attorneys. We do know that he struggled for a while to find fit attorneys when he was dealing with the documents case, which he's still dealing with the documents case. There was actually a hearing about that yesterday.
Right.
The one thing we obviously want to watch is we've seen him previously get target letters and then alert the world that he would be indicted. This last target letter, he said that it would be about 4 days potentially when he can get indicted. So that I'm looking at the letter now. So he said he received a notice on Sunday night giving him, quote, very short 4 days to report to the grand jury, which almost always means an arrest and an indictment. So I think that's what everyone's waiting and seeing.
It's hard to know for a lot of people, and I'm talking of the electorate here, which investigations to take seriously and which ones to ignore. Do you pay attention to all of them? Just as a journalist, from your perspective, which of the investigations currently underway are more serious?
Well, there's obviously the documents case that is incredibly serious, that right now we know that he was indicted, and that'll be tried in Florida. This would be incredibly serious as well. ABC News this morning says this target letter to their reporting mentions 3 federal statutes: conspiracy to commit offense or to defraud the United States. That is one of them. Tampering with a witness, victim, or an informant. These could be very serious charges. And then the third one, we do not know yet, but that is potentially waiting in the wings, is the Fulton County indictment from their attorney general in Georgia. So I would say those 3 are the top ones. But beyond that, there's a defamation case, there's cases against his company, and all this is going to be playing out as he is running for president.
MH, thank you. Looking forward to the conversation a little bit later. Be sure to catch Republican presidential candidate and former New Jersey Governor Chris Christie on Balance of Power at 5 p.m. Eastern Time with AMH and Joe Matthew. Earnings out just seconds ago from Goldman Sachs. Second quarter net revenue, $10.9 billion US dollars, the estimate 10.46. Fixed sales and trading revenue, big number for Goldman Sachs, of course. That comes in at 2.71 billion. The estimate was 2.81. A lot to work through here. Let's get to Shonali Basak, our chief Wall Street correspondent here at Bloomberg for more. Hey, Shonali.
If you take a look at the numbers, John, it's pretty incredible because even though they beat on the top line, there was a pretty significant miss on the bottom line here for Goldman Sachs and the lowest ROE that they've seen in years, let alone a miss for the market as well. So what happened here? There's a few items here that are a little bit hard to parse through. There is the asset management unit that has a nearly $1.2 billion hit to pre-tax earnings because of the hits they've taken to their commercial real estate portfolio. Remember, this is all part of the changing of Goldman Sachs. They're trying to reduce their balance sheet when it comes to the asset and wealth manager. We could talk more about commercial real estate later because they also have a hit tied to Green Sky. This is hundreds of millions of dollars right down because they're taking a goodwill charge tied to that business that they are looking to essentially sell all or parts of. They've announced strategic options for that business. So they've really bit the bullet here in this quarter, and you're seeing it down in the results. What was good about the results? They had equities trading that not only came in above expectations, they also came in above Morgan Stanley. That has been an investment line for Goldman Sachs, and they are beating pretty significantly. This is, I believe, the third quarter they've come in the last year above Morgan Stanley. FICC was a light miss, and it was also a little bit deeper of a turn down than expected. You know, we're going to want to hear from David Solomon and the executives here on whether there is a turnaround here in the trading, in the investment banking story, whether things have really bottomed, because that kind of a tone will set the stage for the rest of the year and the ability to bring in more money, because they have done quite well here in equities, and they are also bringing in record management fees. So have they taken the worst of the pain at Goldman Sachs?
You know, it's completely unfair to Shonali, because you're doing a great job on this with all these banks doing this in real time. I'm buried in the PowerPoint, 15 pages. I'm on page 6. And essentially, as an amateur, I'm saying they did a 21% margin in wealth management, but that was knocked down to a year-to-date pre-tax margin of 6%, quote, from the results of Marcus loans and historical principal investments. Does Marcus permeate the Goldman Sachs world, or is it compartmentalized under some form of consumer banking format?
Listen, when you look at the Marcus business, they have sold much of the loan business that they've said that they're going to do. In fact, they took a $150 million gain from the sale of that loan portfolio. So again, this is a fairly messy restructuring of Goldman Sachs's business lines and that pivot away from that core consumer business into asset and wealth. But here's the problem. Asset and wealth this quarter was really hit by that commercial real estate business. And so they can't seem to get out of it fast enough when it comes to reducing their balance sheet, though they are on track to reduce that balance sheet according to their goals. But it is a tough market, as we know, for commercial real estate. Now, will the market forgive them for it? Those debt and equity investments have also come in below expectations at a time where Goldman is trying to raise more money to have third-party asset management. So again, you have two things, Tom. You have that historical consumer business that we know has hit a rough time and that they're trying to change quickly, as well as their growth area, asset and wealth, which they're trying to sell the story for, but is coming in short this quarter because of that real estate hit.
Shonali, to wrap this all together, is David Solomon losing the room? Is he basically losing the oxygen and the support to keep going as they keep underperforming the likes of their one-time big rival, Morgan Stanley?
There's no way to say this differently, because the ROE of 4% being worse than expected, as well as being not only the worst among, that it's only had in years for itself, it's also the worst among every big bank this quarter. And so that is certainly a tough pill to swallow for Goldman Sachs and its executives. But the question is what kind of leg room does that give David to make all these changes he says he's going to make? He had his strategic plan when he first stepped in, 2018, 2019. Now, he has a new strategic plan. So what is the timeline for that plan to start showing more success? Interestingly, Goldman today, into this morning, is still trading at a higher price-to-book ratio than Bank of America. And so people have been rewarding these institutional businesses, and they've been winning in equities. But is that enough for the market when they're going through all these big changes?
The stock is slightly softer this morning. We're negative 0.08%, wrapping up earnings on Wall Street with Goldman Sachs, the last out of the gate. After the financials, we'll move over to Silicon Valley, big tech, Tesla, and the likes of Netflix coming after the close a little bit later. Let's stay on Goldman and wrap up the quarter for Wall Street. Shonali, based on what you've heard from JP Morgan, Bank of America, Morgan Stanley, Wells Fargo, Citi, Goldman, where do these rank this quarter?
You know, JP Morgan was the unequivocal blowout in the room, right? I mean, they came in with the highest ROE as well as this massive profit jump, even without First Republic. That would have been a huge jump in net income, where you're seeing the big investment banks, Goldman Sachs, Morgan Stanley, take a little bit of a dip. The Goldman decline in profit is significant, and the expense bases are high for every one of these banks, all for different reasons. And so can this comeback in investment banking, can this rise in net interest income, can that save Wall Street this year is my question.
Shonali, thank you. Stock's negative by 0.7%. Shonali, stay close. Shonali's going to come back a little bit later as we work through some of those earnings calls with Goldman Sachs and David Solomon. Goldman, slightly negative. Let's get to the broader market and take a look at equities. If we can take a look at the S&P 500, the NASDAQ, and the Russell. There we go. Futures unchanged on the S&P. On the NASDAQ, we're positive by about 0.14%. Slightly firmer there. Year to date, absolutely flying by more than 40% on that index. As I've mentioned a few times, attention's going to shift away from the financials, and we'll get to some of the tech players, the dominant stories of the year so far in the stock market over the year. Next week, when we hear from Alphabet, Meta, Microsoft, then on to Apple in early August. As I've said, Netflix coming up a little bit later. In the bond market, you will notice there's a bit of a rally, yields are lower. This off the back of developments in the UK. Inflation coming through softer than expected in the United Kingdom this morning, following a similar move in the United States last week. So we pair back the rate hike bets, not just in the States in the last week, but also in the UK this morning. The gilt market rallying really hard, down more than 20 basis points at the very front end of the gilt curve. In the Treasury curve, the 2-year, yields are lower there by 3 or 4 basis points, 472.98. Tom, on a 10-year, we're down 2 basis points at 376.
I don't re-inversion your 97 basis points, not out to something outrageous, but certainly versus the whole market waiting for housing data in 1 hour. We've had a new inversion, back a trend towards where we were a week ago. And the inflation metric, the 10-year real yield, it's just not done much, but nevertheless, it just won't give way to that disinflationary story. It won't make the next lug lower to signal disinflation.
Let's finish on foreign exchange, Tom. Push it through the FX market. More recently, you've seen a much, much stronger euro. That backs away a touch. We're down to 112.11. We're negative 0.16% there on the euro. The bigger move in G10 is in sterling. Cable, the pound against the US dollar, much, much weaker pound this morning off the back of those inflation figures. The pound dropping by almost 1 full percentage point against the dollar. That's a weaker pound sterling, 129.10. If you are just tuning in, welcome to the program. Goldman Sachs out with earnings just moments ago. The headlines read as follows. Second quarter net revenue, $10.9 billion. The estimate, $10.46. Fixed sales and trading revenue, $2.71 billion. The estimate, $2.81, so a miss there. Key measure of profitability, that'll get talked about a lot, coming in much softer versus its peers. Goldman Sachs in a moment, Tom, negative by, let's call it 0.3%, and just dancing around in negative territory.
On radio and television this morning, we welcome all of Global Wall Street, and they know Allison Williams, senior analyst at Bloomberg Intelligence, and brilliant on this. And just sitting here, folks, to look at the 15-page Goldman Sachs Solomon PowerPoint, I'm looking at it in my own way. To watch Allison Williams to my left go over this puppy. How alone is Goldman Sachs right now? My basic take of 15 pages of PowerPoint is no other bank is displaying this urgency.
Well, I think, Goldman is in the middle of changing their business, and so that's always messy and tends to be the weak one, right? So what we saw this quarter, Shonali pointed out the very low ROE, and a lot of that is due to the commercial real estate impairment. So you've heard me talk and probably many others that commercial real estate is going to be a long story for the banks, for most banks lending. But Goldman Sachs has a sizable investment portfolio. This is something that, prior to the financial crisis was significantly built dip. They're shifting that strategy,
Right.
but they're taking those hits today because they're mark to market. And so, if anything, I think it highlights the fact that they're already in the process of unwinding that strategy, right? So instead of putting all these investments on their balance sheet, they're going to a model where they invest alongside investors and have fees. And there will be write-downs, right? There's gains and there's losses.
In that 15-page PowerPoint, I'm thinking like a Betsy Graysick, Mike Mayo kind of question. Which is the ratio or page or deck that shows the Solomon excellence right now? Which shows that he's righting the ship and moving forward?
I think, I'm not sure if the number one number is in this presentation. I think to the point that we just spoke about the alternatives. The alternatives fundraising, I think, is what's most positive about the future. I think from an analyst, whether a sell-side or buy-side analyst point of view, the cost ratio is the thing that analysts are going to focus on, because we did have these big impairments. So obviously that is suppressing returns. But if we strip all that out, Goldman still has to do better on the efficiency line.
So we're now at the end of the earnings season for the big banks on Wall Street. Is the conclusion that JP Morgan won and Goldman Sachs lost?
I mean, from a bottom line perspective, you could say that. I would say from a broader picture, credit card is the business, and if you are exposed to that business, you are doing well. And I think we're going to see that JP Morgan, not just versus a Goldman Sachs or Morgan Stanley, but versus some of the regional banks as their results come out. Credit card is where the loans are growing. We know it's a very profitable product over time. You could say it's over-earning right now. So as those losses continue to tick up, a year from now, we might be talking about winners and losers for the quarter based on that business. But certainly it is, I wouldn't say Main Street's winning over Wall Street, because it's a very specific part of Main Street, right? Like, it's not the bread and butter commercial loan. So it's not really Main Street, because card is a little bit of a different business. But Wall Street's certainly taking it a little bit on the chin this quarter.
Especially because the people who are getting this credit card business, the consumers, have very high FICO scores. It's not as though they are on the floor trying to make ends meet. We are seeing, though, aside from credit card lending, a real decline, a real deceleration in loans by both big and small banks, and a real retraction. Apollo's Torsten Slok coming out with a deck talking about how much he expects this to continue with lending to slow. What's your view? I mean, is that basically the conclusion here as they pay up for deposits and as they start to get a lot more cautious about who they'll lend to?
I do think that the commercial environment will continue to slow. Of course, how bad that gets depends on your view of the economy. It seems like, in general, the market's view of the economy is improving. But I think that until we get that recession, we'll be talking about the recession when it comes or if it comes, et cetera. And so I think that there does have to be some element of factoring in the potential downside. But the fact is, commercial loan growth is slowing. We saw improvement. Bank of America talked about utilization rates. Their customers have sort of steadied on that front. But for the quarter, net interest income, that was the big story for upside. That's where you got the big upside from JP Morgan. Again, I think that's due to card. The other thing is that the cost of deposits, we've been talking about this a lot, especially since the bank failures in March, where there was a deposit flight. I think that has steadied to a migration, which is what you would expect. And I think that there is a bit of a relief, at least at the big banks, that it's not... It's steadying, it's not as bad as feared, and the outlook is also steadying.
I've got the chart normalized from that Thursday in August of 2007, and it's all the different banks. And as an aside, folks, Goldman Sachs looks pretty good there versus Morgan Stanley when you go back 15 years or whatever it is. It is stunning how Citigroup is alone. What is the urgency to get, I say Bitcoin, BitDog. What's the urgency to get CitiDog righted fast? It is an outlier of all these fancy names.
It is an outlier, and it's probably, I would say, maybe the most frustrating stock for people that
so
cover
what do they
financials.
Do? I said this to Corbett
been years,
and Davos.
It's been years and years.
John, it's flatlined from the spring of 2009 as a general statement. What's the to-do for Citigroup to join the team?
I think Jane is doing it. I think Michael Corbett started it. Jane Fraser is taking sort of a steeper axe, and perhaps the best thing that could have happened to them is this regulatory scrutiny and the fact that the regulators said, look, it's been a long time. You really just need to get things in order. So they're making these necessary investments, which continues to weigh on the short term, but in the long term will finally get them to be a more efficient bank. And I think what Jane is doing in terms of, focusing on the profitability of markets, the international retail banking business is a business that only 2 banks were ever in globally, HSBC and Citigroup. And we've seen it doesn't work. And I think that is finally that sort of mea culpa. Instead of having these bragging rights, let's not focus on the top line, let's focus on the bottom line.
Best thing that's happening to Goldman this morning, that Tom's talking about Citi and not Goldman. Alison, thank you. Alison Williams there of Bloomberg Intelligence. TK, they're probably happy with that, aren't they? That you're talking about Jane Fraser's challenges and not David Solomon's.
First of all, I'm an amateur in this.
Right.
And Alison Williams is legendary. Yeah. And you got all these adults we talked to about this. I just don't think enough's been said about going back 15, 16 years. Goldman Sachs, based on the Bloomberg data I have, has outperformed Morgan Stanley. Morgan Stanley's really come along coming out of the pandemic, wealth management. We know the story. But I don't know if this is a blank fine blame, a Solomon blame. There's all this angst out here. And the fact is, JP Morgan, Goldman Sachs, Morgan Stanley, Wells Fargo, Bank of America down below, and then CitiDog brings up the back end.
Is that your new name?
It's my new name.
For Fraser's shop.
But I get it going. I mean, I was sitting on, I was younger. I was thinner, talking to the football player from Harvard. Corbett, get this thing going.
It's not Corbett's fault, is it? That you
this
were
is Mr.
younger
Wow.
and thinner.
You know who I'd like to talk to about this? I'd like to talk to Jamie Dimon about this.
I'm sure Jamie would love to be on the record on this.
Yeah, I know from way back with Bank One. I mean, Allison's over there nodding her head, but come on. I mean, it's the ugliest chart in global finance.
And I'll just add in, because I do think it's important, because we get so wrapped up in the quarter and who won this quarter and who lost this quarter. But it is important that an investor has to take the long view, right? And the quarter is just mile markers on that long view. And so, so Goldman, it's a tough quarter, but what's the journey they're on? The question, we just look at it to see, like, are they making the steps to get there? And then, as you said, pulling back and looking at Citigroup, it can sometimes be a long journey.
Alison, thank
you.
you.
It's new CFA.
Thank you very much. It is a journey.
It's a journey.
You are just tuning in. This is a journey. Welcome to the program. Equity futures negative 0.05%. For Goldman, the stock is slightly negative by 0.4% of Goldman Sachs. Didn't talk much about the headcount. 45,000 employees at the end of March. At the end of June, 44,600. 5% fewer workers at Goldman Sachs, Tom. Seen a lot of that, haven't we? Compared to the pandemic hiring boom, that stuff is over.
Yeah, and it'll save it for another day, but I think the cost discipline here forward, given the interest rate regime that we've returned to, is going to be interesting.
Stacked hour coming up for you. Amanda Lynham of BlackRock coming up shortly. Neil Dutter of Renmac in the next hour. Look out for that conversation. Equity futures right now, just a touch softer from New York. Good morning.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
There's no question that with China GDP being slow and their inflation being relatively tame, that tends to create more disinflation and slower growth in the United States, all things being equal, and I think it's a factor to consider.
That's a voice I've missed on the FOMC. The former Dallas Fed President Robert Kaplan there weighing in on the next move for the Federal Reserve. That decision, by the way, is a week today. A week today for the Fed's next move, and most people anticipate that next move will be a rate hike. It's not about July. It's about what comes in September and beyond, and for that matter in August in Jackson Hole, if Chairman Powell, as we anticipate, does deliver a speech. And a compare and contrast from Jackson Hole last year to where we are, spot the difference in the labour market. Unemployment in and around 3.5%. Spot the difference with Fed funds. That's easier to do. We've gone from 0 through 5%, and yet still we haven't bitten into this labour market in quite the way that people thought we would. Equities right now on the S&P 500, negative by 0.07%, just a bit softer there. The rally in Treasury continues. We're down 3 basis points on a 10-year in the US, down much more in the UK as we get another soft inflation print. In the West, Tom, in developed economies, the UK today, the US last week. We wrap up earnings on Wall Street with Goldman Sachs, the stock just slightly negative by 0.5%. Fixed sales and trading revenue coming in a little lighter. So many headlines you need to get through, but of all the big bags on Wall Street over the last week, at least I think most people concluding that this was where there was going to be an area of weakness, and you can identify that this morning.
They lowered expectations, and they didn't cross that hurdle. And that's the reason why we just heard Allison Williams say Goldman Sachs is the loser of this earnings season, and JP Morgan is the winner. Going forward, if that changes, then the question really lies with the Morgan Stanley question with James Gorman, which is, do we now see a revival?
TK, wrapping up earnings on Wall Street.
I think with Goldman Sachs, you go through the 15 pages and you look at consumer and Marcus, and as we were talking about in the break, I mean, it's a people business at the end of the day. And, you know, I'm going to cut Mr. Solomon some major slack.
That's the first for you.
It is.
Yeah.
It is. He was given this. He was handed this, and he's managed it forward. And, you know, the fact of the matter is, on some of the pages, they're actually doing well. Number one in this, number one in that. They just got to work it out and get through it. And they're doing it in a new interest rate regime, which I think is not a small note.
Yes, agreed. 5 is different to 0.
Yes, that would be true. It was free money and easy before that. We're going to move on right now. Amanda Lynham joins us now, head of macro credit research at BlackRock. But there is an equivalent overlay here, and that is Mr. Solomon and others, including Mr. Fink, have to deal with the new interest rate regime, which harkens back 16 years, 20 years, 25 years. And as you brilliantly say in your note of macro credit research, there's a new higher cost of capital. Have we adjusted to it, or are we in early innings?
I think, and good morning, thank you for having me. I think we're in the early innings of adjusting to that. And I think one of the really interesting things from my perspective in looking through the regional bank earnings, even yesterday and earlier last week, was that companies are taking reserves against interest-sensitive pockets of the market, like commercial real estate, for example. But they're saying that they'll need those reserves even if there is a soft landing. And so it's not necessarily reserves in the event of a worst-case downturn, but it's reserves even if we kind of get an okay outcome. And I think that's true for areas like leveraged loans, for example, where we expect the default rate to outpace that for high-yield bonds. And I think it's also true for areas like commercial real estate, where we, as you know, Tom wrote that we think we're in the early innings of that distress cycle. And I think what's really challenging in this pocket of the market is that there's going to be a new sense of price discovery. So maybe the LTVs and the cap rates that the market has used in previous periods to kind of understand where the floor is on commercial real estate, they might not be as relevant this time around. And so rather we'll look at cash flow of assets, we'll look at the basis to require to be bringing those properties up to market. And that's very heterogeneous, and I don't think we know the answer to that.
How ring-fenced do you think that pain might be? How isolated do you think it will be in credit?
I think we're expecting most of the pain to be on the smaller banks that the data just tells us have had bigger exposure over time. We're also seeing that's where a lot of the reserves are being upticked, but I don't think it's limited to those areas. And I think in some ways the cash is fungible across the system. And so if that's a reason for certain parts of the banking system to pull back on their lending, then that may be felt in other areas of the market that aren't necessarily directly related, but impacted nonetheless.
And even as is right now, we're seeing a big contraction in auto lending as well as others, aside from the credit card loan area, which seems to be on fire. How much do you expect that to accelerate and pressure credit in other areas?
Yeah, I mean, you guys were talking about it earlier this morning with some of the restructuring news, and I think it's interesting that companies are already restructuring some of the maturities that are coming out 2025, 2026, 2027. And so I think on the corporate side, that's definitely going to be a pressure point. On the consumer side, I think it was really interesting. You had mentioned that the Federal Reserve data for the Center of Microeconomic Analysis earlier this week, there was a chart in there that showed financial distress. And it showed the percentage of consumers that thought they might need $2,000 coming up over a period of time, and those who thought they would be able to get it. And those numbers are moving in the wrong direction. And so I think for the consumers at the low end of the economic spectrum, I think there's going to be a pressure point. That being said, I view it as more normalization as opposed to deterioration in the consumer.
That's where I was going to go with this, especially at a time when some people are saying we've only seen a small part of the ramifications from the Fed tightening cycle. How far do you expect the deterioration to go, and how will it be expressed in your credit markets?
So I think, the first half of 2023 has surprised us to the upside in the terms of the resilience of the corporate credit market, specifically when you look at the high yield market and the leveraged loan market. That hasn't extended, though, all the way down to the very low end of the capital structure. So if you were to look at the current level of the high yield index, so 380 basis points, at that level, you would think that CCC spreads would be tighter than where they are now, around 100, 150 basis points tighter, actually. So we're not seeing that. So I think there's a limit to investors' comfort with over-leveraged, deteriorating fundamentals. That probably extends. And so there's a lot of talk about kind of the equity market rally broadening. What I actually think is there's probably some scope for resilience still at the high end of the high yield spectrum, specifically because supply has been so low. Technicals, which are really important, as you know, in the credit market, have been so friendly. But I think that's probably a near-term issue. Over time, I would expect there to be a bit more weakness in that market as we see defaults flow through, as we see risk premium rebuild. Importantly, we don't view a recession as a necessary ingredient for an uptick in defaults. So similar to how these banks are talking about, we'll need these commercial real estate reserves even in a soft landing. I think enough damage has been done in the cost of capital environment that Tom alluded to that we'll see an uptick in defaults regardless. It won't be broad-based. It'll be more focused on, for example, the leveraged loan market on a relative basis. But I don't think we're immune.
Let's cut to the BlackRock chase. The bottom line is Goldman Sachs has a page on commercial real estate. Shanali covered that. Ellison Williams alluded to that. We were talking this morning. We've got our wonderful offices at Queen Victoria Street in London, and there's a Motel 6 I stay at across the street. It's like 2 blocks away. And in between our office and the Motel 6 is this office building. It's a B property, and it's in the media this morning. Basically, it's at half its value. I'm speaking as an amateur. Maybe it's 40%, 60% discount. That seems awfully pervasive in each and every city. How do BlackRocks, how do Blackstones, how do Black this, Black that, how do they adjust to that over, say, 2 years, over a refi cycle?
Yeah. So, I think we're early in the innings of this distress cycle. And I think what's really important is the price discovery. I think one of the other points of conservatism it's really going to be relevant in this particular cycle is that we look a lot at kind of Class A, Class B, Class C properties, but the market is evolving so quickly that those Class A properties may be reclassified lower
this is
going
really,
forward.
I can't say enough off, John, about how this is important.
And I think just because something is Class A today, as it becomes older in ages and there's more competition and there's more price discovery, probably lower in competing assets, that may get all turned on its head.
That's
It's like faint echoes of 15 years ago when I hear you say things like that. It really is. I'm not saying it's as scary or will be, just, you know, some similarities there, some parallels.
I think it's going to be a longer default cycle. In the financial crisis, we know that was a multi-year cycle. Perhaps it gets front-loaded a bit.
Into the market now?
I don't think it is priced in it. Because of that, price discovery is lacking.
Price discovery, that's my phrase for the day.
Amanda, thank you. Just brilliant. Excellent, as always. Amanda Lynham there, BlackRock. Absolute clinic on commercial real estate. Victoria Fernandez of Crossmark coming up very shortly. We're going to turn our attention to the earnings still to come after the close from Netflix, from Tesla, and some housing data about 34 minutes away from New York City. This is Bloomberg.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
the data is kind of starting to show us that maybe we won't have that recession.
Business is being remarkably resilient.
If the economy continues to actually chug along here, we avoid a recession.
I think we're heading back towards a 2% sort of era.
Unless we get more loosening in the labor market, it's hard for us to see that inflation durably, sustainably comes back to 2%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. I guess we're done bank earnings. No, we're not. Much more to come across the regional space and the bank. Netflix reporting this afternoon. John, you alluded to this earlier. Thank God the big banks are over. Now we go on to real America.
Yeah, can we talk about Netflix? Let's talk about Netflix. Crackdown on password sharing. They've already led us to believe that subs are going to be up off the back of this. We'll see what the number actually looks like. A lot of people think that's been discounted in the stock. The name is up by something like 60% year to date. You've also got these strikes, Tom. What does the catalog look like over at Netflix? How can they retain their audience, the eyeballs, for the next 12 months if this continues? There are some analysts, I'll talk to one a little bit later, who believe that this network, Netflix, this company, is best positioned to handle this.
I look at the log chart and on the rebound off the pandemic and the recovery here, as you mentioned, the password, are they going to have a more persistent cash flow and all that? Maybe they're closest to getting back on trend of all the beleaguered media business. You know, I think maybe
they're making money,
Tom. They're making money.
They're making money, and the challenge is for a lot of people that got into this business, I'm thinking Disney Plus, thinking others too, who were chasing subs, can they do the same thing? They've been cutting back some of those other names. Well, so it looks like Netflix is on top, and I think you see that captured in the name so far this year.
I wanted to dive into the Barbie hysteria right now, but we're not going to do that. Too important an hour. Victoria Fernandez joining with us here in a moment. But the bottom line is, John, is earnings season out in bulls reaffirming. To me, the headline was Jonathan Golub at Credit Suisse, a bull lifting ever higher.
4,700. Earnings season for me, Tom, starts next week. This year has been dominated by big tech, the big seven. They start to report earnings next week. Tesla I know a little bit later, but next week when you get Alphabet, Meta, Microsoft, and onto Apple in early August,
totally agree.
That's going to define earnings season for a lot of people, particularly if you were in those names so far, Tom, in 23.
Lisa, your thoughts here on it, and take it to the credit. Amanda Lineman was just brilliant, I thought, there on slicing and dicing this. What does credit say about our equity bullishness?
Well, I think right now what you're seeing broadly is a risk on feel. The question is, what are the fundamentals and where do they start to bite a little bit more, especially as we see some of the big bank earnings demonstrate that restraint in lending. And she was talking about how we could get a default cycle even if we don't get a recession. There will be companies that will have a difficult time paying back their bills, refinancing, cutting their debt loads, akin to what Carvana is trying to do this morning or achieving that. But, you know, on a broader level, this speaks to the near term, potentially momentum continuing, and the longer term, at some point, fundamentals matter.
Can I point out that 4,700, 1 year out from now, is up 4%? I mean, that's how
it sounded super bullish a few months ago.
And Uber super bullish, and we've come so far. You know, to be fair to John Golub, he's been killing it, but it's a tweak.
It's a tweak.
Yeah.
Binky Chad at Deutsche Bank with me, Tom, 9:30. Got nothing else to say. That's just my tease.
That's just get out for anybody
want an
else.
Equity market book.
Anybody else on the show?
Exactly.
Anybody else on the show?
Plenty of people. I'll tease them later.
Oh, you'll do it later.
Right. That's the tease of the tease.
But I mean, Lisa, I'm trying to understand that the bond world is out front of the equity world, and I think what I've heard is it's pretty quiescent here on defaults, fear, gloom. No, except commercial real estate.
Well, I think, look, there are a lot of issues here. There's a granularity of perhaps private credit markets having the same dynamics that the high-yield bond market used to have, and some of the distress more apparent there, this according to some people. On a larger sense, and this is what we heard from Anna Hahn earlier, we have seen the fundamentals come in not so strong. People look past that because they see their 401ks getting bigger. They see what their money is doing in the stock market. They're like, let's go. We're happy. They keep buying. And how long can that continue regardless of what we get in earnings?
Well, VIX 13.34 is, come on, we're happy. That's a pretty good number. It's a bull market, John.
It is a bull market. Or is it? Some people still think this is a bear market rally.
Do a data check
you
for
might laugh
Binky
at
Chad.
that, but seriously, some people still think. Morgan Stanley, Mike Wilson still believe this is a bear market rally.
And even the bear, I mean, we mentioned BNP Paribas,
There's a
Daniel
divide
Morris,
there.
Greg Bowdle, very cautious.
Greg Bowdle's even more cautious, and has been for a while. Equities unchanged on the S&P. Bonds with a bid, we're rallying here on treasuries, on gilts. Inflation softer in the UK. Yields are lower by 3 or 4 basis points on a 10-year in the US, 374.63. It's onwards to housing data, Tom, in 25 minutes.
It's going to be interesting to see right now. To join us, Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. And the charm here is twofold. One is she is living the heat wave across our heat dome in the Southwest. And two, she's got a heat dome of her own of clients who were afraid and missed this equity market. Let's go to Abilene 106 to begin with, Victoria. What is the actual anecdote you see off this horrific heat wave in your Texas?
Yeah, look, it is killing it here when it comes to the heat. We are super hot down here, and I guess you can relate that somehow when you look at utility stocks and what's going on with ERCOT down here in Houston, with the Texas grid and what's going on there. You can relate it to the energy sector, but I also think you can look at the hotness that we're seeing in the equity market right now. You know, I have been much more cautious on the market than a lot of people have as of late. I look at what's going on in the market and I can say, yes, I see this bullish momentum, right? It's the momentum factors, the price factors that are leading this equity market right now. And you have to take advantage of that in some way. But the interesting part is we see this momentum and then we look at all of these red flags that are flashing in the market as well and say, how do we combine these two things to have some risk management for our clients while still taking advantage of the heat wave in the market?
Let's pick a name. Netflix, up 61% year-to-date, reports earnings later. Victoria, what do you do with a name like Netflix, with performance like that?
Yeah, these names that have run up so much this year, I think you do have to be a little bit cautious here. You talked earlier about some of the increase in subs because of the password sharing going away, that's been priced into the stock. And we saw a jump in the stock price on that previously. So listen to some other elements that are coming out. Let's hear what they're saying about advertising. What are the subscribers that are using the ad-based component? What is that looking like? Are you seeing some of the subscribers coming on to the lower priced components, or are you still getting some of the higher priced in there? What does that look like? And look, if you're going to have a strike, if you're going to have an actor strike and a writer strike, you've said it before, Netflix is well positioned to kind of go through that because they have a lot of international exposure. I mean, I'll watch a foreign film with subtitles. I'm okay with that if there's nothing else on TV. So I think Netflix can ride through that a little bit, but be cautious if you don't own it yet. I think you can tweak your position depending on what happens with earnings this afternoon, but I'm not sure I would go all in on the name at this point. Wait for a pullback if you don't have it already.
So as everybody does get this sort of euphoria that we've been hearing about, how are you navigating? You don't want to get out of the market, but it sounds like you are shifting away from some of the big tech names into some of the more defensive areas. How much have you been doing that over the past few weeks?
We've been doing it quite a bit, Lisa. I mean, we have been much more cautious, I'd say, than the market has been itself. Because of these red flags I mentioned a moment ago, you look at leading economic indicators down 14 months in a row, you look at the inverted yield curve and the starting to see it steepen a little bit, that's actually your signal historically of recession coming. There's a lot of these elements that are out there that are telling you recession could be there. But the support that you're seeing in the market, high beta versus low beta, industrials versus utilities, is telling you there's still some momentum there. So yes, we have some cyclicality in the portfolio. We have tech names, Lisa. We're just not buying some of those high-flying names that you guys were talking about that are going to start reporting earnings. We're buying names like Adobe. We're buying names like Oracle. But we're also going in and having some of those more staple names. Grocery stores like Kroger. You've seen grocery prices come down a little bit. People are buying more groceries, so Kroger's a good name. General Mills. You see some of these that have been hit in the staple sector. I think you can go in and pick some of these names up and give a buffer to your portfolio because we do think it's still going to be really choppy, and we're not taking a recession out of the cards 100% at this point.
Where do bonds fit into this, Victoria, especially as we were just talking with Amanda Lynham of BlackRock, who said we're going to see a default cycle even if we don't necessarily get recession?
Yeah, we've seen some of the lower investment grade names. We not necessarily that their defaults are going higher, but the leverage components are going higher in some of those names. And so you want to be careful and watch that. We wouldn't be in high yield, which I believe is what she said as well. I think you're playing a little too risky if you do that, with the thought that we do think there still could be a mild recession later this year. But credit has a place in your portfolio. You can lock in some yield right now. We've seen the shorter part of the curve come down a little bit as expectations of the terminal rate has dropped about, 20-25 basis points over the last few weeks. But you can still lock in a 4.75, a 5% on the short end of the curve, catch that coupon. There's no reason not to do that. And couple that with something a little bit longer out the curve, add that little bit of duration in your portfolio, because if yields have peaked at that 4.25 or so for this cycle, then you want to have some longer duration and take advantage of yields coming down in 2024.
They're coming down this morning in 23, that's for sure. Victoria Fernandez across Smart Global Investments. Thank you. It's been a year of pain trades in 2023. Yeah. One of them, I have to say, is in credit, Lisa. High yield credit spreads still near the tights of the year at 379. We were going to be talking about,
I didn't know that.
380, yeah. South of 380 now. Lisa, we were talking about going through 550 on Fed funds, right, and the pain that would come, the default cycle that would begin, and what would happen to credit spreads that gap wider as we went into recession. And now people are talking about no recession all over again.
And even if they talk about recession, then they say, well, there just hasn't been any issuance. No, by the way, the issuers are even better quality, so it doesn't really matter. And at what point do we start to see high yields lead and give a sense of
missing out right now? I just wonder how to gauge the fury of people that they didn't know Netflix back when Queen's Gambit was #1.
Netflix going in one direction. I never watched that, you know. I didn't
it's very good.
Yeah, I'll check that out.
It's one of the few things.
What about foreign movies, subtitles? You into that? Check out Cinema Paradiso. You'd love that movie from the late 80s.
I'm into those.
Great movie. You'd like that. From the late 80s. You know, it's a really, just a nice story in a nice fictional town in Sicily. It's beautiful.
Where you want to live.
Yeah, you know.
It's a sensitive.
If it's too hot over in Phoenix, I'm told it's too hot and people are staying in.
It's brutal.
You know, it's hot in the summer in Phoenix. If you're just joining the program, welcome to the program on the S&P 500 futures, positive by 0.01%. Coming up in about 20 minutes' time, we'll get you some housing data. This is the latest from Citi. Softer than expected UK inflation will keep markets optimistic. The resilient US growth can coexist with global inflation slowdown. But housing data this morning may serve as a reminder of ongoing supply-demand imbalances and remaining inflationary pressure. Andrew Hollenhorst of Citi. I'm looking forward to Neil Dutt of Renaissance Macro on the housing market, TK. You've got him coming up at 8:30 Eastern time, so just after that data drops.
Yeah, it's going to be interesting. And what I learned this week, and maybe it was 10 days ago, is I looked at the relative size of 4 or 5 states. And the real estate market of New York, Florida, California, and such is totally different than everything else. I mean, it's not homogenous in any way, shape, or form.
You wanted to say something on Phoenix?
Well, I think you just think it's always hot in Phoenix, but now it's really hot.
I know it's really hot.
It's really hot. But you're like, you couldn't even say that. You're saying, because evidently it's
record hot.
It is record hot. It's incredibly hot.
Just they're painting you've seen the weather charts now.
Oh yeah, all the time.
They're like painting them like
red.
So red it's purple.
Yeah, and it's like all red around. But it's true. I mean, it's.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Earnings season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
You see this kind of network and cable, these media groups still having that pull. We thought that might be that sweet balance. That was one of our largest calls. And right now, as we see it, we've stepped off that pullback call. Well, we'll throw in the towel, we'll admit ourselves on that one. But something we're still watching here is, what is going to be the pace of this rally in the back half this year? And can this AI and really Uber top-led rally continue? I think that's what's really weighing on people's minds.
It's the number one question for a lot of people in the equity market. Anna Hand there, equity strategist at Wells Fargo Securities. Do the winners keep winning, or does this rally start to broaden out beyond the mega cap, Uber cap, tech-led names on the S&P 500?
See if they lift.
Once you go through 1 trillion, it's no longer big cap, is it? I'm not even sure mega cap gets it done anymore. It's like, it's like unheard of.
Nano cap.
Yeah, we want to go with that.
It's like
whatever.
It's called the index.
Take your pick. It is called the index.
That's exactly where we're at.
That's nice. The S&P 500 futures just about positive, turning positive in the last couple of moments. In about 13 minutes, we'll get some economic data, housing data, and then your opening bell, Tom, an hour after that.
Right now, we're going to dive into this, folks. This is important. And we're coming up on the serious housing data, which I'll give you good coverage on. And that is the surrealness of the moment in the world of Mandeep Singh. He is senior surreal analyst for Bloomberg Intelligence, dealing with AI, dealing with the silly valuations right now. And just as one idea, Mandeep, with the Microsoft's melt up yesterday that we saw at the new highs, they're heavily burdened by 3.1% long-term debt. They have a weight to cost and weighted average cost of capital of debt of 0.1%. I haven't even looked at free cash flow generation other than gajillions, and I can just see them. Is it in Redmond where their offices are still? Are they still in Redmond? They're in Redmond screaming, we got to get to 3 trillion market cap by August 1. We got to catch up. Is there that competition between Microsoft and Apple to get bigger, better, and all that? Is that tangible, or are they two separate worlds?
They are separate in the sense Microsoft is coming at it from the enterprise side. Apple obviously is heavily consumer focused. And right now, I think everyone, even though they're focused on AI, what Microsoft has done yesterday is said that AI is just not a feature. We can monetize it with a product. And they're talking about a $30 subscription on top of what they're selling with their Office suite. That's huge. I'm sure they've done some due diligence in terms of figuring out the pricing around it, because for a new product like that to be priced at such a high point, that's telling you something that they're confident that this will resonate at the enterprise level.
We're speaking with Mandeep Singh of Bloomberg Intelligence ahead of the beginning, the sort of inception of the earnings kickoff for big tech, which will happen after the bell today. We're going to get IBM, we're going to get Netflix, and how much are we going to learn about where the bar is set and whether it's too high or too low?
I think the incremental revisions, the positive ones, are going to come from the companies that can monetize this generative AI wave. And look, expectations have gone up. But what Microsoft said yesterday is we could generate almost $30 to $40 billion in incremental revenue over the next 2 years. That's huge. That's not in the consensus numbers. So that's where you have to be selective with companies. I don't think every company can do it. I mean, you have to go to the semiconductor makers or the software providers that are at the cutting edge when it comes to monetizing it.
So are you saying that you suspect that people are overpricing the monetary boon that will come from AI and how democratic it will be spread?
Well, so right now, everyone is talking about AI. You listen to any earnings call, any management team, they're talking about AI. In terms of what it does to your top line or profitability, that's what you got to figure out. We know these workloads are expensive. It's going to raise your infrastructure costs. Can you monetize it? And that's where I think there is some gross margin offset. But as long as you can do what Microsoft said yesterday, they are looking to monetize. That's huge. That's all, 40% incremental margin. And that's what the street is looking for in terms of driving these positive revisions.
What is the sustainability of a Microsoft double-digit revenue growth? I say this as I look at 10% 5-year dividend growth. I'm looking at a ginormous multiple. It's not like luxury of that, but it's a stupid multiple to be direct. But are people just modeling in AI, non-AI? I really don't care about AI, but are they modeling in double-digit revenue growth for the Mandeep Singh world?
Well, as of right now, you see these companies are expected to grow at 10, 12% top line.
Right.
And
you call that revenue growth.
The AI contribution isn't there. So that's in line with the software spending. And that's where, it is a zero-sum game in the sense if Microsoft is able to pull off 20% plus growth, that's coming at the expense of something. If generative AI is driving 40%
but
growth.
on a simple basis, if I go 10, 10, 10, 36 months out, I'm up 30% in revenue growth. Do you model that in your world?
Well, so again, you have to look at how the software spending grows. Historically, it has grown around 10%, and Microsoft is growing in line with the long-term growth rates in the software sector. Now, if they're growing 20%, that's coming at somebody's expense. And you can already see that legacy to like cloud shift. Now this is going to probably speed up in the sense people are going to invest in digital transformation initiatives. They did that post-COVID. That's going to take to a new level in terms of what they could do with AI.
Lisa, Adobe's trading at an LVMH model. It's like they're moving leather goods in Paris or something. I mean, Mandeep's world is nuts.
It's probably more lucrative than that at this point. Mandeep, I do want to just end with a quick note on Tesla because they are reporting earnings after the bell. And we have seen this cut in pricing over at Ford. How much is some of the demand for EVs as luxury vehicles and at that price point? How much is that really coming off?
Well, again, everyone is thinking Tesla is not just an EV maker, but there is an autonomous driving element to it. And that's what's driving the valuation. Look, generative AI is built around proprietary data and what you could do in terms of automation and stuff like that. And Tesla, to an extent, was early in terms of thinking about that kind of model. Whether that helps them, roll out their FSD software to the entire install base, that remains to be seen. But we know people have paid $15,000 for that FSD software, and if they can kind of expand that, that would be a huge high-margin business for them.
Keep an eye on Formula One, not because of Netflix. See what they can do with a hyper-efficient engine with sustainable fuels, and let's see if they back away from a hybrid engine. Then I wonder what's going to happen to the auto industry. That's why I'd be watching Formula One over the next couple of years. I think it's going to be really interesting.
That's the only reason why you watch that?
Not just that, but
it's
very interesting from an industrial policy perspective what all these administrations, all these governments worldwide are doing right now. I think it's arguably very good for economic growth. To get all that, fantastic for employment. But how much these companies spend to invest in electrifying their manufacturing lines, Tom, and to come up with these EVs, and then what happens in 5 to 10 years if we come up with something better?
You have been, John, way out front on this. You could do a job swap and work for Mandeep Singh's.
I don't think Mandeep's team want that.
I could just see John Farrell down there. You've been way out front on this. I've really been thinking about it off your comments, and I go back to the Detroit International Auto Show. It's got to be 12 years ago with Ken Pruitt, and the head of Mercedes there said to me, Tom, only hybrid will win. And he was heated about it, that all EV, they can't figure out how to do it.
We get where the government wants to go. I understand that, and that's a very powerful thing. But what the engineers come up with I think it's going to be pretty interesting the next 5 years.
Especially with the national security overlay, given the fact that a lot of the materials that go into these batteries come from China. So there's a question about who the winners, who the losers are, and what the alternatives are that get discovered in this process, to your point, that take over that industry.
They'll be testing it with David Ricardo. I think it's going to be great. I mean, it's really going to be important at AlphaTauri, what they do with
Daniel,
sorry.
You know what it's really about? I just missed the noise. I missed the sound. Mandeep, thank you.
Mandeep's like, why the hell am I here?
Appreciate it.
That was great on Microsoft. Really, really interesting.
Coming up next hour, Subhadra Japa, George Bory. Looking forward to that from SocGen and Allspring, respectively. Binky Chadha around the opening bell of Deutsche Bank. And then we're going to be speaking about Netflix and the earnings still to come with Alan Gould of Loop Capital Markets, Managing Director over there, Tom. So that's going to be fun. Equities on the S&P just about unchanged. You're opening about 1 hour away. Up shortly, housing data and the brilliant Neil Dutter of Renaissance
AI
Macro.
and housing.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. Bloomberg
surveillance, job claims tomorrow, but today housing starts, housing permits, all that kind of stuff with red and green on the screen. The VIX 13.35. Yields are lower. The yields have come in a little bit. Of note, 10-year 3.74%, and the 2-year note 4.1%. Is well. Brent crude, importantly, over 80. There's sort of a looser feel to the market today. Lisa Bramwitz and Tom Keenan with us. Joining us, an expert at America's housing economy, Michael McKee. Michael, data this morning.
Data this morning, and this one comes out on time. Housing starts drop significantly, 8%. Of course, that follows a 22% rise the prior month in May. So average it out, and it isn't all that bad. But the expectation was for a 9.3% decline. Building permits are down 3.7%. They were up 5.6% in May. So kind of average that out. We have a revision to that May figure for housing starts here, 15.7% instead of 21.7. But basically what we're seeing is a healthy home building market. There was I noticed this morning, there was a study out from Redfin that said 91.8% of Americans have a mortgage under 6%.
Yes,
and 82% under 5. And so nobody is selling their existing home. So the thing you got to do is buy a new home, and they're building them pretty much as fast as they can get. You look at the statistics for how many people are employed in construction, and it's not keeping up with the business they're doing. So that's a limiting factor.
Is mortgage rates a limiting factor? I mean, if we get disinflation, I guess mortgage rates come down. But where they are right now, into the autumn, are they a limiting factor?
Oh, they're definitely a limiting factor. A limiting factor on the existing home side. So that pushes people. Oop, I'm pushing my microphone. That pushes people into the new home market.
Well, and that's the reason why I find it interesting that in some ways the home builder stats are a direct outcropping of the mortgage rates as they are. We are seeing a slight tick up, at least in the mortgage applications earlier today. How far can they go with this? How strong is the demand, and at what price, right? I mean, how much are we seeing the disinflationary effect of some of the materials really spur the activity that we keep getting in the home building sector?
I don't think it's so much disinflation. A lot of the home builders were buying down your mortgage to try to get you to sign a contract. I understand that's easing up a little bit, but you could get in the 4s not too long ago, concessions from the home builders. You're right, the price of construction materials has come down. That helps the builders, and maybe that helps you get a little bit more in your home. But this has kept some parts of the economy afloat. Appliances and electronics and furniture. We saw big gains yesterday in the retail sales report, and that's one reason why.
Turn to the market right now. I'm not going to say much going on. The 2-year yield 4.70%, in a little bit 6 basis points. Before I leave you, Michael, you're back from Rocky Mountain. We could talk economics there. But in honor of the late, great Ken Pruitt, who helped us invent Bloomberg surveillance. Ken Pruitt was a great fisherman, and you have the mother of all fishing stories. To use the phrase from Ken, you caught a trout the size of your leg. What'd you capture out there? You went hunting for a fish?
It was the last fish I caught, and it was 28 inches, rainbow trout. And
so that's bigger than 2 feet.
Yes, it was big, and it snapped the rod when I was trying to land it, and I managed to land it.
Did it bite you? I mean,
no.
What were you fishing?
Trout generally don't bite.
Did you take the Ellen Zentner School of Trout Fishing? Is that how you do this?
Oh, yeah, it was fly fishing.
Fly fishing?
Yeah.
Could you, how come we don't have a life like he has? He's fly fishing in the Rocky Mountains.
There's a rumor that you're going out to Jackson Hole later this year and going to take fishing lessons.
And there's no way.
Brammo, are you going to take fishing lessons?
Sure, I would take fishing.
You went canoeing last year.
That's right. I would take fishing classes. Why not?
We'll get everybody out there to fish.
Get us. Thank you so much with our economic data today. Right now, and this is important here, with green on the screen, nice little fractional lift of the market. For those of you gloomy, this is the interview of the day. There have been optimists. They are congenital optimists, and they're also reasoned optimists. And one of them is Neil Dudda. He's head of U.S. economic research at Renaissance Macro, and has been extraordinary, not over the last 3 months, 6 months, but frankly the last 2 years of saying this is America, the resilient. The Dudda chart is out there, Neil. And it is finally, we have legitimate real income growth. Will we sustain that?
I believe so, Tom. Thanks for having me on. Obviously, there's a lot of disinflation in the pipeline, at least over the next, you could say 3 to 4 months. The most obvious is used cars. We know that wholesale auction prices have been coming down. That's going to bleed into consumer prices for used cars and trucks. Supply chains are improving. That's going to take some pressure off of core goods outside of vehicles. And there's still some disinflation in train with respect to shelter, looking at new lease growth. At the same time, we know the labor markets are holding up, and that's going to support real incomes. And if real incomes are rising, ultimately, I think consumers are going to go out and spend that money. So I think that's sort of the linchpin for why things are holding up better than expected.
Atlanta has a GDP now numbers. We came in at a 2% statistic Q1, and all of a sudden we're migrating 1.82-ish on Atlanta GDP, whatever it is. I really don't care what the number is, but my question is, to the gloom, what statistic of positive GDP in America is a so-called growth recession? Is it 0.5%, 0.5? Do you have that number in your head?
Well, I would define a growth recession as a situation where the economy has a, the GDP has a positive sign in front of it, but that growth is not strong enough to keep the unemployment rate from rising. So typically in a growth recession, you'd see the unemployment rate go up. So it's effectively a below potential growth state, Tom. But that's not what we have right now. I mean, you mentioned the Atlanta Fed. That number is tracking 2.4%. With very little contribution from consumer spending. I suspect that probably builds over the summer, frankly. But
wow.
But look, there's more upside to the economy than not. But we're growing above potential, and that means that whatever unemployment rate increase you see, sort of bobbing around 3.5%. I mean, it's probably going to be short-lived. We're not on a situation where we're going to see above 4% unemployment.
Goldilocks seems to be the moment that we're in. That's what a lot of people are saying. How long can Goldilocks last?
I mean, talk to me in the fall, Lisa. I mean, that's what I'll say. I mean, I think I'm sort of in the Goldilocks for now camp. I mean, I do think that there are reasons to be somewhat suspicious about how long this can last, about whether this is a durable, sort of sustainable moderation in inflation. I think that's a question that needs to be answered. I don't think we can answer it just yet. But, to me, when you think about economic scenarios, I think the risk of recession has receded dramatically. And so now it's a question for investors about where do you put those other percentages, right? I mean, I think the markets are right to kind of allocate a little bit more to the soft landing story. But I think, I think you can make a good case that maybe we're getting a little bit over our skis here, and we should probably put some more potential on the resurgence of the inflationary boom scenario.
Okay, well, I wanted you to double down on that because you were just saying that people are perhaps a little too sanguine about the steady disinflation that they expect to see. Where is it that you see reinflation coming back down the pike, especially if you hear all these people saying that Fed policy hasn't worked its way through the financial system and still has more restraining to do?
Well, home prices are rising again. They're actually rising for 4 months in a row. We get weekly data from Redfin, and that's more up to date. And that shows continued increases in home prices over the summer, even after seasonal adjustments. So, to the extent that home prices go up, and obviously if you're a landlord and the underlying value of your asset is rising, you're not going to go around saying, "Yep, I'm going to start cutting your rent." So it leads me to believe that we could see some upward momentum in housing rental inflation in the CPI statistics sometime, let's say in the first or second quarter of next year. So that would be the most obvious area. But, more broadly, I mean, let's take a step back and, what are we talking about here? We're talking about real growth improving. Real growth is improving. Over time, that erodes physical capacity, and that forces economic actors to bid up wages and prices. So, I have a little bit of skepticism in terms of how far we can push this kind of immaculate disinflation story.
Just real quick here, Neil, given that, how far do you think the Fed could go? I mean, do you think that people are pricing out future rate hikes after this month and that's inaccurate, that you think that that's wrong?
I mean, who am I to say what's right and what's wrong? But I would just, if it were me, I mean, I think the probabilities of a hike, after July are probably somewhat higher than the markets are currently expecting.
Neil Dutta, thanks so much. We've got major breaking news. We're going to have to run off. But Neil Dutta, they are extraordinary on this 2% American real GDP. He is with Renaissance Macro as well. Our timing was a bit off. We had Mandeep Singh half an hour ago, and we were doing giggles about more Microsoft. But here are the headlines. This is off the Activision Blizzard earnings announcement. And Lisa, it's a set of headlines that gives you an intraday lift to Microsoft. And it's fractional, but that's off the melt up yesterday. I'm going to clock it now at $3.61 per share at about a 5% lift since about 10 a.m. yesterday.
The acquisition of Activision Blizzard has been held up in a bunch of litigation and other regulatory concerns, a question around whether it will get executed or not. Activision Blizzard giving Microsoft more time to complete the $69 billion merger. That's the latest news, prompting a leg higher just slightly in pre-market trading. They're extending the deadline to October 18th. And so they're going to also...
It's a good amount of time.
But also in return for this, Microsoft agreed to a higher termination fee and some new commercial agreements. So trying to kick the can as they work through some of the regulatory issues.
Well, the regulatory issues, I wonder how we see and in what way we receive a response from the government in this, given the travails the government has had in the last number of days. I'm colored by this. I don't think clearly on this. I was with Bloomberg. I have the clearest memories of just one headline slipping out on a lazy day, 10 a.m., 2 p.m. I was worried about what was in the food court, said government drops all actions against Microsoft or whatever it was. I mean, the whole government angst and all that, and then all of a sudden they go...
They haven't been very successful with their antitrust pushes, and that's been something that Linda Khan has been a bit concerned about. I know a lot of pushback from Congress.
Microsoft then again into the Netflix earnings this afternoon. The Standard & Poor's 500 near flat, up 0.1%.
After the bell today, we get Netflix earnings as well as Tesla kicking off some of the big tech earnings. Yeah, and this to me is going to be interesting, especially given the run-up that we've seen in Tesla in particular, but also Netflix shares. This is the big test. John was referring to this, that yes, big bank earnings kick off the season, but the meat is going to be in tech names as they either deliver or not after all these expectations.
It's a cross-section, and I think the dispersion of businesses, of the way the income statement looks, the balance sheet looks in tech is far greater than in banking, and that's to say that Goldman Sachs is a very different platform than JP Morgan. I think, as Mandeep said, Microsoft is in enterprise world and Apple's in the retail world, so to conflate them all together, I think, is really unfortunate. We'll try to avoid that.
It's a good point, but in terms of returns, you can conflate them a little bit, albeit at a different scale. Netflix shares up 61% year to date. Tesla shares up a cool 138% year to date, just to give you a sense of the incredible roar that we've heard. And nothing is just a car company.
At 361 shares, I'm looking at 6-7 shares, I think, as a first purchase of Microsoft. Annualized return over the last decade of, I don't think I should be in there. Bill Gates is not involved anymore. I think I shouldn't buy it. 29.3% per year.
Well, how do you price innovation? How do you price market dominance? How do you price getting out ahead of trends that have to be adopted by companies around the world?
A chart out, I'm going to give credit to JP Morgan 10 days ago or so on how much money you've lost by not being in the market, by not participating. It is jaw-dropping. Futures up 2, Dow futures up 5. We quote the Dow for John Farrow. Stay with us. From New York, on radio, on television, this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country? Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
When you look at investment banking, trading, advisory, when do they come back, and how robust will that activity be?
Well, I don't know when exactly. I do believe it's bottomed. I think deals will start getting done. Whether they happen in the back half of this year, I'm not so sure. It might be next year that it comes, but it will be during next year when we see it, if not this year.
James Gorman, and we say good morning to all of you of Morgan Stanley there, the success of his wealth management effort and much other with Morgan Stanley with our Sonali Basak this morning. Lisa Branwitz and Tom Keene here. On a Wednesday, yes, there's economics. The housing data that came out, I'm going to call it a percolation to the market, is pretty much what we see right now. I should my Bitcoin under 30,000 is a topic for the 10 a.m. Hour. Futures red and green on the screen, the VIX 13.30. Right now, we're going to have a conversation that we did not have with Sonali Basak and Allison Williams. They are in the heat of the earnings coming out, the numbers, the PowerPoint, and the ratios. But with Sri Natarajan of Bloomberg News, we can sit back and actually look at the discussion that's being had. Sri, I'm looking at a board. I'm going to go all William Cohen on you here. David Vinier, who lived 2007, 2008. Peter Oppenheimer, who we talked to all the time. Kimberly Harris, a new board member, Kevin Johnson. What's the spirit of the board if they look, and it's too much to say the train wreck, but just simply the tension and complexity of the underperformance of Goldman Sachs. How's the board respond?
And don't forget the new incoming board member, Tom Montag, at Goldman Sachs for over 2 decades, then at Bank of America, now returning to Goldman Sachs.
What will be the response of the board?
I think they will tell you that the stock does not fall off a cliff. They're okay. They're not getting antsy because over the last 5 years, since David Solomon took the seat, October 1, 2018 to today, Goldman stock has done well. They will tell you they've done extraordinarily well. The reality is they're middle of the pack, and middle of the pack is not a crisis.
This is critical now, and I'm thinking of David Vinier. I have the clearest memories of him and I going back and forth on LIBOR OIS August of 07, and he had that huge responsibility running the ship essentially financially at Goldman Sachs. The collective memory on the board at Goldman Sachs, including Mr. Montag, how do they respond to this? Is there like sharp words, or is it like a McKinsey meeting where everybody's planning in a complex way to move forward?
I think reality is no one on the board is going to be very comfortable seeing all the noise and the headlines coming out of Goldman Sachs. But what they ultimately want to see is stock performance, They want to see that they're on target to achieve some of the goals they've set out. There's obviously been strategy turnaround, some 180s they've done on their retail banking strategy, but they have committed to a new strategy. As long as they can deliver on that, the board will be content and okay. It doesn't look like anyone on the board is thirsting to make a change right about now.
Where's the growth going to come from in the new strategy?
Well, that's important. A lot of analysts, some of the analysts at least, have called this a kitchen sink quarter. Try and throw out all the bad stuff in this quarter because the numbers are really bad. Return on equity, 4%. How does that compare to some of the peers? It's the worst among the big banks. You have JP Morgan posting 20% return on equity. So that's not good. And you've had a few consecutive quarters of Goldman missing on its profitability goal, which is a mid-teens ROE. So the question is, where does the growth come from? You know, and we heard James Gorman talk about this yesterday. Gorman said investment banking, the trough in investment banking has arrived. It's going to look up going forward. When capital markets reopen, when deal making goes up again, you can be rest assured that Goldman will be in a good place, and they will look to point out the increasing durable revenue growth in their asset management business.
It seems as though the banks that are most diversified and largest have been benefiting the most from the recent enthusiasm, at least over the past few weeks, of bank shares. How is Goldman going to try to appeal to this? Or are they going to say, no, we essentially are a niche markets-focused bank. We tried our foray into consumer banking. It didn't work.
No, they'll certainly not say that. They tried a different tack. They said we're a very good investment bank in trading and banking, but we're going to expand into retail banking. We'll make that as good as our investment banking franchise. That clearly didn't happen. You wasted a few years going deep into that space and now trying to retreat. But now they're talking about the two pillars, the investment bank and the asset and wealth management business. And that is the one place that they can hope to show growth going forward.
Your color there, I think it was page 6 of the presentation, very clearly laid out. Commercial real estate has challenges. What is their uniqueness in commercial real estate versus the other major banks?
Quite a few important things, right? Investments where they have operational control. They're mostly tied to commercial real estate, about $10 billion of investment there. They took a $500 million hit there. They have equity investments, a lot of it through principal investment.
Like a skyscraper in Singapore, just as a generalization?
From offices to warehouses and everything else that falls under the commercial real estate rubric. They have about $28 billion in loans in the commercial real estate space. So that's about 15% of their total loan portfolio. So they've taken some hits there. They've taken hits on their equity investments and also on what they call their consolidated investments. That's contributed to about $1 billion hit this quarter. Their hope will be they're not taking any more write-downs going ahead, and that's really important for them and not entirely in their control as well.
Headcount has gone down by about 5%, I believe, based on the latest assessment. How much more does it have to fall?
5% year to date. 8% is probably another figure to look at because that's year on year, doesn't include the new analyst batch intake. One would think that they've done the biggest exercises needed. They haven't come out and explicitly said that. And if they do need to take more action, that tells you there's a lot more bad news to come out of there. So they will certainly be hoping that they do not have to take any more headcount actions. They've already done 3 different rounds in the last year, and that doesn't show great management, frankly.
Just taking a step back, we did just wrap up the earnings cycle in the big banks, and it seems as though the themes are deposits cost something, particularly if you're a smaller bank. Credit is contracting on the margins, and credit cards are the sweet spot. How would you wrap that together to push it forward and say where this is going for the next quarter?
Yes, all of those points are true. Credit is perhaps contracting, but look at the commentary that we've gotten from some of the big consumer banks. Look at what JP Morgan kept telling us. Charge-off rates are going up. It'll probably end the year at 2.6% on their credit card portfolio. They keep repeating this is a normalization, not deterioration. This is normalization post the pandemic. They're not that concerned. So if you zoom out, the economy is not as bad, or at least the trajectory does not appear to be as bad as 3 or 4 months ago. So if that holds up, the consumer stays okay, Main Street remains okay, Wall Street opens up with the return of capital markets, that'll only mean continued good news for the big banks going ahead.
You're going to be out at the U.S. Open, Tennis Open here. There's like the Grey Goose Pavilion or whatever it is. Sri holds court there for like 3 weeks or whatever. It is. What's going to be the chit-chat at the Grey Goose Pavilion at the Open about what would Tom Montag do? Here's this force of nature. I've dealt with him at Davos, love him to death. What an interesting guy. Is this just like a moment, or is this going to be a big deal where he steps in?
He's a force of nature. We've obviously seen a lot of commentary around this. Reality is, at least based on our reporting, and I know some other people disagree, but Goldman had been in conversation with Tom Montag for several months
Who'd
before
been in
the
conversation?
recent noise.
Is this Solomon dialing 1-800-SAVE-US?
It's at least Solomon dialing 1-800 Tom Montag. He's in the past told me he's one of the greatest partners at Goldman Sachs. He's made an effort to court Tom Montag over the past few years, brought him back into the famous Goldman Sachs retired partners dinner, something that Montag had been avoiding for several years.
Sure, Bank of America,
And David Solomon certainly brought him back into the fold. And in the last several months, he's led the effort to bring him onto the board. And remember, he is a big, prominent voice when it comes to risk expertise, and that is still a big engine at Goldman Sachs.
Sri Natarajan, thank you so much. Look for Bloomberg Reports with Sri Natarajan here on Goldman Sachs and on the rest of the banking season as well. My basic take on this, Lisa, and it goes back to David Viniar and the crisis of 07, 08, 09, is this time is different, but the difference is that chart I mentioned earlier of the shocking 07 to now outperformance of JP Morgan and Goldman Sachs, frankly, doing very well. I think it's completely underplayed, their outperformance of Morgan Stanley looking back 16 years. I don't think that's in the zeitgeist right now.
When people are talking doom and gloom about Goldman Sachs, they're talking about the recent missteps with Marcus and underperformance on the margins with respect to Morgan Stanley. Longer term, you're absolutely right. But going forward, where is the growth model? And that continues to be the question at a time when they're still very much an investment banking firm. They're talking about asset management. Everybody wants that golden goose. Can they get that market share compared to Morgan Stanley that's made all these acquisitions, E-Trade, as well as their massive wealth management business?
A little bit of a bid to the screen here. Futures up 3, NASDAQ futures up 0.3%. It'll be interesting to see what happens there. To drive forward the political discussion, the news with Washington waking up here at 8:56 Wall Street time. The gentleman from New Jersey, Christopher Christie with Anne-Marie Horton, Joe Matthew, Balance of Power this evening. Timely, to say the least. Stay with us on radio and television. This is Bloomberg Surveillance.
Access the financial world on demand.
On radio and television, this is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Did our
conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Live from New York City this morning. Good morning, good morning. Equities totally unchanged on the S&P 500. Wrapping up earnings season on Wall Street and shifting our attention over to Silicon Valley. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, global bonds rally as rate hike bets unwind. Goldman wrapping up earnings on Wall Street as investors gear up for numbers from big tech. We begin with the big issue, the right kind of downside surprise.
The narrative has been around inflation.
UK inflation
coming in below expectations.
So much better than had been hoped for.
This is a step in the right direction.
It's a positive sign.
Inflationary pressures are still too high.
We should certainly not get overexcited here.
The Bank of England will still have to tighten interest rates further.
What do we see in the US? We see far greater progress on inflation.
This kind of disinflation mirage.
Disinflation everywhere.
We're expecting inflation to come down.
We should get even better numbers in Q3 and Q4.
I wouldn't be surprised if it starts trending higher.
We got to look for prolonged period of stability.
We're not quite done with this cycle yet when it comes to inflation.
The Fed needs to be still very adept in terms of monetary policy later this year.
Let's get straight to this bond market. SocGen Subhadra Rajappa, who is looking for lower yields. Subhadra, you've got them right now. Welcome to the program. Big rally in the gilt market. Treasury market rallying too, yields lower. Are we set up for a summer here of lower yields?
I think we might be set up for a summer of range-bound markets, given the fact that you have seen some progress on the inflation front, but the data, broadly speaking, in the U.S. is still relatively strong. We got a pretty decent retail sales print. The Michigan sentiment indices show that sentiment is improving. Consumer spending still remains relatively strong and robust. So you're going to see an environment where the strength in the fundamentals is going to support perhaps yields around these ranges. I mean, 10-year yields perhaps between 3.5% to 4%. Before you see that leg lower in perhaps the fourth quarter, if we do start seeing a slowdown in growth and the potential for a recession in the first half of 2024, we're just not seeing it in the data yet. There are no imminent signs of a recession, so it's status quo for now.
There's more happy talk than that, though, Subhadra. The idea being that we can bring inflation down to an acceptable level, in the words of Jan Hatzius of Goldman, without a recession. Do you think that's possible?
We'll have to wait and see how the data plays out. I mean, March, when we had the regional banking crisis, that's a cautionary tale that you could see some disruptions in the market because of tightening credit conditions. The housing market, for the most part, has remained resilient. Even the interest rate sensitive sectors of the economy seem to be holding up, even though the Fed has aggressively raised rates. But that's not to say that we couldn't see a further tightening of credit conditions. You are seeing credit card delinquencies go up. You're seeing default rates start to rise in the credit market. So we're watching a variety of metrics to see if that'll play out in the second half, and that could potentially lead us to a meaningful slowdown in the first half of 2024.
I want to bring George Bory of Allspring Investments into the program as well. George, wonderful to catch up with you. Just talking about these downside surprises, not just in the UK, but also in the United States over the last month, and whether you see further potential for this bond market to rally, for Treasury yields to drop.
Yeah, Jonathan, thanks for having me on the show. Good morning. Bond yields can trend lower over time, and we think we're at a point in time where, as we've seen a cool down in inflation. Growth has remained much stronger than people expect, but there is sort of expectations that kind of moderates going forward. And so we think kind of the structural backdrop, for interest rates are favorable. We saw a bit of a pop in 10-year yields just a few weeks ago, and that has sort of gradually come down. And so when we look at sort of the overall kind of macro environment for both fixed income and bonds more specifically, it's pretty favorable. We have very strong carry. Yields are ranging anywhere from, high 3s to 4% up to as high as 12%. That's a lot of income. And as yields kind of moderate, we get a little bit of capital gains as well. So bonds can do exactly what they're supposed to do in this environment, and we think that's a good thing for investors.
Well, let's see if we get the slower growth to take that Treasury market even further. Let me share two quotes with you, and you tell me which one you find more convincing right now. One's from BNP Paribas, or rather Capital Economics. Another is from Citi. This is from Capital Economics. Excess savings are all but eliminated. The impact of higher interest rates and tighter credit conditions will gradually feed through. Student loan repayments are scheduled to resume. We could argue that consumption growth will continue to underwhelm in the second half of this year. That's Capital Economics. This is Andrew Hollenhorst of Citi. Said soft landing optimism is premature. Tight labour markets, elevated wages, upside risk to shelter and other services inflation mean we do not share the optimism. Absent a tightening of financial conditions, inflation may re-accelerate in early 24. So, George, it's either consumption gets smashed in the second half or inflation re-accelerates in early 24. Which one is it, George?
Yeah, I think growth is held up very well and much better than people expected. One of the key factors that's in the market that doesn't seem to get enough attention is just the balance sheet strength of both individuals and corporations. And when you have lots of low-cost debt supporting your sort of asset base, that provides you with a lot of financial flexibility. And so that can help sort of the growth train kind of as sort of things unfold. It also means that inflation is not, perhaps gonna just sort of simply collapse. And it takes time to sort of get inflation down. Now, we're in the sweet spot where inflation's coming down fairly quickly because of base effects and some residual sort of slowdown. But I think the latter risk of kind of a moderation of this trend, and that the risk is that inflation kind of goes back up or it doesn't go down as fast as people hope, that seems to be more of a risk than this kind of sudden collapse or meaningful hard landing. And it all goes back to that balance sheet strength. It's like a ballast. It's like an iceberg that's basically, effectively, supporting the economy. And that iceberg's pretty strong, until you get to that sort of cracking point. We haven't reached it yet. We're seeing some signs, as my colleague mentioned earlier, there are some signs within the credit market that default rates are going up, that higher costs of borrowing are weighing on some individuals and corporations in particular. But it's not enough. It's not enough to sort of meaningfully sort of impact, that trajectory of growth. It will come. High rates and an inverted yield curve will work. It will slow the economy. But it's that sort of ballast that's in the system that's still strong and still hasn't sort of eroded enough to kind of see that meaningful hard landing. So yes, recession's pushed out into next year. Is it hard? Is it soft? Hard ultimately results in these types of conditions. It's just taking a lot longer than people expected.
So, Badger, can I ask you the same question? Which argument are you more convinced by? That consumption gets smashed later this year, or ultimately things hold up and inflation reaccelerates?
So I agree with George's comments in the sense that I think it's going to be easy to get inflation. I shouldn't say easy, but it's going to be relatively straightforward to get inflation back down between 3 to 4%. But getting from that range on to 2% could take a lot longer. I don't know necessarily that means that there's going to be a reacceleration in inflation. It really depends on the trajectory for employment. When we were talking, George was mentioning cracks. We really need to see the job market crack meaningfully. And that's really where you're seeing a lot of the strength, is that the labor market is extraordinarily tight. And as long as people have jobs, they're going to continue to spend, and consumers are going to remain relatively resilient. That's not to say that inflation is going to gradually decline in the second half, and perhaps interest rates and Fed policy could accomplish lower inflation by just staying where they are right now. So I think range bound, Fed on hold for the remainder of the year makes sense. I think it's too soon to know if inflation is going to reaccelerate meaningfully next year.
Big rally in the UK government bond market this morning. We're down by more than 20 basis points on a 2-year, down on a 10-year this morning by around about 16 basis points, following softer than expected inflation data out of the UK. Mike McKee has the numbers. Morning, Mike.
Good morning, John. As you can see, UK inflation came down much more than anticipated, as did inflation in the Eurozone, and that has people thinking about where the level of interest rates needs to get to. Now, if you take a look at what we're seeing in the overnight index swaps market, U.S. Investors tend to think that the Fed is just about done. But while the Bank of England numbers have come down significantly, this is for end of the year, the base rate for them, there is still a feeling they've got a long way to go, and the ECB has a long way to go. The dotted lines are where we are now, and the solid lines are where they think they're going to end up. So even with the optimism in the UK today, much more work for the BOE to do, and much more work for the ECB. But the Fed may be getting to the point where it slows down. Now, Subhadra made a really good point about whether people have jobs or not. Take a look at what happened today in the housing starts market. While we saw a decline, we saw a big increase the month prior, and new home, single home family homes have continued to jump. So most of the weakness in multifamily homes, but there is still a lot of building going on. And what does that mean? That means you need construction workers. And if you look at the total number of houses that are under construction right now and the hiring, you can see hiring's fallen off. They're still looking for people out there to go help put these houses in the ground. And that just suggests that the labor market is another reason, at least, that the labor market's not about to crack.
Mike McKee, thank you. This post-pandemic economy is fascinating and frustrating at the same time, trying to work out what on earth is going on. George Bory, I know you're talking about the global inflation backdrop. It's something you and the team are focused on. Are you expecting regional inflation trends to diverge or converge? What are you looking for?
Now, we're expecting divergence as we kind of look around the world. You know, what we're seeing is that, you know, the global inflation shock is kind of dissipating, and then different economies are starting to diverge. You mentioned the UK already, you know, which has had much higher inflation than sort of other parts of the world, particularly here in the U.S., but even versus continental Europe, and some moderations starting to emerge there. But yet inflation in other parts of the world are starting to, you know, are either remaining high or in some cases actually been coming down. Places like some of the emerging economies, inflation's actually coming down. And so, you know, we're sort of well through that sort of global shock that we experienced, you know, sort of last year. The dissipation of that means interest rate differentials, you know, are starting to diverge at least a bit. You know, global, you know, rates as it relates to sort of the developed world do tend to move a little bit together, but we are sort of seeing a breakdown. And so, you know, we look at sort of opportunities to either, you know, invest in overseas bonds and perhaps bring those investments back to the U.S. by swapping those securities. Those, you know, can be very attractive to investors. But playing that dispersion, playing that divergence in rates is a really nice diversifier in portfolios. And that's one thing that we have been trying to implement, is really try to diversify that exposure away from just, say, exclusive dependence on U.S. rates, look to overseas markets, look to play that dispersion, and then bring those investment returns back to, say, a U.S. dollar investor. That's been a fairly attractive trade and opportunity this year, and we expect more of that as the year unfolds.
Subhadra, what's your take on that?
No, I completely agree with George. I think coming into this year in our year ahead outlook, our key trade idea was to go long treasuries versus bonds. And in the anticipation that treasuries will outperform bonds this year, we saw that outperformance where 10-year treasury bond spread went from 170 basis points earlier on this year to 100 basis points during the regional banking crisis. It's widened out to around 140 right now. We do see that spread again narrowing one more time by the end of the year, given the fact that the ECB is still catching up on the policy front, and they're probably going to hike, a little bit more than the Fed, and they're also going to be a little bit more cautious about cutting rates or pivoting because of the fact that inflation is relatively high and higher than what we're experiencing in the U.S. You look at 5-year forward, 5-year break-evens in Europe versus the U.S., you're seeing that inflation expectations in the U.S. are a lot more contained than they are in Europe. So higher for longer in Europe would mean that the divergence would probably hold up for a little longer this time as opposed to in past cycles.
Mr. Badger, just one more question from me on the Federal Reserve, if we can. A week away from a Fed decision, a week today. This just in from Bank of America and Mike Gaitman and the team. This is what they look for. 25 basis point hike next week. They see this on September. We continue to expect another 25 basis point hike in September for a terminal target range of 550 to 575. So, Badra, is it one and done or more to come?
It's one and done, from my perspective. Really, to me, whether they hike once or twice is not very meaningful. If you're going to tell me that they're going to raise rates by 200 basis points to fight inflation, then that's a paradigm shift. 25 basis points at next week's meeting and another 25 in September or another 25 by the end of the year is not going to really move the needle because the market's ultimately going to be looking towards what happens to growth and inflation over the upcoming year. And if growth is going to slow down meaningfully, then 10-year yields are going to trend lower. So the long duration trade is going to work out regardless, in my view.
Sabadra, that's Sabadra's bias right now. Yields lower, potentially, in the future. Sabadra Rajappa, George Bory, to the both of you, thank you. Appreciate it, as always. About 15 minutes away from the opening bell. Equity futures on the S&P 500, slightly positive by 0.1%. Plenty of earnings out there this morning. Let's get a few of them for you. Here's Abby.
There certainly are, John. And let's start out with the shares of Goldman Sachs, which are sliding but off the lows. This, of course, from a disappointing quarter on many fronts. Profits tumbling 58% on their investment banking business slowing down. Real estate concerns plus the FIC trading, a bit of a miss there. AT&T up 6.1% as they say that less than 10% of their cables nationally have lead. Cowen is positive on the company's response to allegations made by the Wall Street Journal. Argus, on the other hand, has cut, seeing this as a new material risk, but investors siding with the bulls, up 6.1%. Netflix up 1.3% ahead of reporting earnings tonight after the bell. Investors think that they will put up streaming paid subscribers of about 235 million. Folks will really be looking for that crackdown on shared passwords. This stock on the year, John, up 61%. This will, of course, be one of the first big tech companies to go for the second quarter on these big gains. Will the results hold up?
And how the writer's strike might impact some of these companies as well. Abby, we'll have a chat about that in about 30 minutes' time. Coming up, wrapping up earnings season on Wall Street.
Decent economic growth, stable markets, the banking system, balance sheets are strong, and consumer balance sheets are okay. That's a pretty good backdrop. The earnings are not really bad. They're not great, but they're not disappointing.
That conversation up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I do believe it's bottomed. Every CEO I'm talking to has tilted to a more forward-looking posture. So I think deals will start getting done. Whether they happen in the back half of this year, I'm not so sure. It might be next year that it comes, but it will be during next year when we see it, if not this year.
That was Morgan Stanley CEO James Gorman in conversation with Bloomberg's Sonali Basak. The bank earnings continued to roll in on Wall Street. Goldman Sachs seeing one of its weakest quarters under CEO David Solomon. Q2 profits plunging by 58% due to an investment banking slump and real estate markdowns. Regional banks under pressure too after Western Alliance fell short of estimates amid mounting funding costs. Let's get to team coverage. Bloomberg's Sonali Basak alongside Herman Chan of Bloomberg Intelligence. Sonali, that just about does it for Wall Street, doesn't it?
It sure does. And we have Goldman Sachs really biting the bullet here. You look at the commercial real estate losses, they're taking a hit to pre-tax earnings of $1.2 billion nearly. Now remember, Goldman is taking these hits now. The question then becomes, do they have more on top of what they're already taking? And what does that look like across other firms as they continue to weigh that commercial real estate impact that could last many, many months? For Goldman Sachs, the sense is a lot of the pain is being taken right now. They're also taking hits on their consumer business here with a write-down of a goodwill charge tied to Green Sky. So the question for David Solomon is the worst over? Can we call this the kitchen sink quarter? Is everything thrown in here? Now take a look at this. They did beat on some key areas, equities trading, financing up. They are the #1 shop on Wall Street this quarter around in equities trading. Underwriting is coming back pretty strong. That is usually a good signal for the advisory business. Fixed income a little short of expectations. But if you take it all in all, I want to give you the big picture here, John, for just a second, because Goldman's returns on equity were the worst across all the big banks, given the hit that they took. Now, if you take a look here at that 4% ROE they bought in, it would have been above Morgan Stanley at 9%. We'll let the market decide how they feel about the hits that Goldman have taken. But that's how the scorecard plays out for the year. As for David Solomon now, if you take a look, that 4% ROE, they're still expecting to make that mid-teens ROE over time, but it had peaked so far in 2021, at the end of 2021 for David Solomon. So what's his plan to turn this around?
Goldman right now down by 0.6%. David Solomon in focus. Is the worst over for him? Is the worst over for the regionals? Let's talk about the smaller banks outside of Wall Street. Herman Chan, the good news, deposits are back. The bad news, it's costing them a lot of money to attract those deposits. Should I focus on the good news or the bad news?
You should focus, at least this point, on the earnings trajectory going forward. The bad news with net interest income continuing to decline, and a lot of the regionals, including U.S. Bank, Citizens today, PNC yesterday, are talking about some additional top-line pressure with net interest income declining in the third quarter with respect to higher deposit repricing. So it's going to be a bit of a slog going forward as regional banks sort of digest the higher rate environment and also competitive pressures from the likes of JP Morgan increasing their deposit pricing, which is reverberating across the regional bank space as well.
I'm going to sound like James Gorman. Things are getting better, but they're still not great. on Wall Street and beyond. Shanali Basak, Herman Chance, to the both of you, thank you. Look out for more commentary from Shanali around the opening bell on some of these earnings calls. Looking forward to that. Equities right now positive by 0.1% on the S&P 500. Coming up in the morning calls and later, Deutsche Bank's Binky Chada joins us around the opening bell with his outlook for earnings and beyond. That conversation just around the corner.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell. Futures just with a little bit of a lift by 0.1% on the S&P. That's the price action. Let's get you some morning calls. First up, Morgan Stanley raising its 20-year price target to 75, saying the stock will benefit from mounting AI tailwinds. JP Morgan upgrading Cisco to overweight, highlighting an inexpensive valuation and resilient earnings growth. That stock is up by 1.7%. And finally, Cowen raising its Microsoft price target to 390, expecting further upside due to growing demand for its new products. That stock is very positive by 0.5%. Coming up, earnings season ramping up with more from the big banks and big tech results on deck. Tesla, Netflix after the closing bell. We'll catch up with Deutsche Bank's Binky Chada on his bullish call for the rest of this year. From New York City, your opening bell up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
Seconds away from the opening bow this morning. Good morning. Equity futures slightly positive by 0.1% on the S&P. Two-day winning streak on the S&P 500, the highest since April of last year. On the NASDAQ 100, the highest since January of 2022. Equity futures on the NASDAQ positive by 0.2%. There's the opening bow. Switch up the board. The focus will shift, of course, from the financials to tech. We'll talk about tech in just a moment, and the banks as well. In the bond market, yields are lower worldwide, and the gilt market much more so off the back of softer, lower than expected inflation in the UK. That downside surprise sparking a rally in the Treasury market too. We're down just a touch there on a 10-year yield by a couple of basis points, down almost 2 to 376.98. We snapped that winning streak for the euro in yesterday's session. The weakness continues this morning. 112.14 on the euro against the dollar, negative by 0.1%. And sterling cable down almost one big figure this morning, from 130 down to about 129 off the back of that inflation data. Taking a look at crude, we're positive there by 0.66%. WTI up about 50 cents to $76.25. About 40 seconds into this session, equities positive by 0.3% on the S&P. On the NASDAQ, up by about 1/3% as well. The sector to watch over the last week, the financials. Goldman Sachs wrapping up earnings on Wall Street, reporting its lowest quarterly profit in nearly 6 years. Western Alliance missing Q2 estimates as efforts to rebuild deposits come at a cost. Abby has more. Hey, Abby.
Hey, John. And yeah, both of these stocks are under pressure on these disappointing quarters. Goldman missing the adjusted earnings estimate by 22%. Those earnings tumbling 58% on a year-over-year basis on a myriad of issues. Their FICC trading missed. The investment banking was weak. They took a $1 billion impairment charge in commercial real estate. There was a goodwill write-down relative to the consumer business. Now, coming into today, the stock had been down about 2%. You compare that to JP Morgan into their quarter, up about 10%. These results not entirely a surprise. Now, relative to Western Alliance, it's clear that they are paying up for their deposits. Their interest expense grew eightfold to $451 million from a year earlier. This, of course, was a fear for all banks, but really materializing more so for these regionals. They also had some issues with credit quality on, in particular, corporate real estate and hotels. But the interesting thing, John, as you remember, during the height of the turmoil in March, this stock down about 90% year to date, now down 30%. So really coming back from those lows. The KBW Bank Index, well, at this point, it is down 15%, much better than when it had been down about 30%. So these financials underperforming on the year, but improving from the bottom.
It's getting better. Abby, thank you. And to Abby's point, the deposits are coming back for the likes of Western Alliance. That's the good news. The bad news, it just cost him more money. Interest expenses up 25% from the first quarter into the second. That's how much it's costing a bank like Western Alliance to attract that money back into the institution. Plenty of commentary out there this morning. This from Truist on that bank, reiterating their buy rating and writing this: Western Alliance has successfully demonstrated the ability to grow deposits and improve capital levels. We expect there to be some pressure on shares given the recent outperformance, lowered guidance, and negative credit migration. That stock is negative this morning by 1.7%. Let's turn back to Goldman. The chairman and CEO, David Solomon, weighing in on the results. He said this: global banking and markets delivered solid returns, and we remained #1 in completed M&A. I remain fully confident that continued execution will enable us to deliver. The earnings call underway. Shanali, he's putting a brave face on this morning.
He certainly is. Everyone's calling it the kitchen sink quarter. This was a little bit expected here, but these write-downs are significant. Without them, they would have had an ROE north of 9%. But because they are here, it is worth addressing whether we'll see these kinds of losses again. Some of the consumer business won't take the same kinds of losses, and you did hear David Solomon just on the call talk about the risk-off posture that Goldman Sachs has taken in the second quarter. Now, this now becomes a story of what does the second half of the year look like. The pipelines are building when it comes to advisory, according to Goldman Sachs, and do the markets businesses also start to roar back? We have known that they've inked ROEs north of 10, 20% in the last couple of years with those markets businesses. The markets have rewarded them. Today, Goldman Sachs is still trading at a higher price-to-book ratio than Bank of America, which is trading below its book value. And so these investment banking businesses have been rewarded. But again, the market is still flip-flopping on Goldman Sachs, not knowing whether some of these troubles are completely over.
James Gorman said to you over at Morgan Stanley yesterday, Shanali, that the worst might be over. Is that just for Morgan Stanley, or do you see that right across the investment banking business for these big players?
You know, it's funny. I talked to a few sources of mine at the tops of these big banks after that comment, and they said they won't necessarily always go as far as James in that comment to say that the bottom has been hit. But certainly things look like they're improving. Anything could happen. Here's the problem. After all the job cuts, even if the job cuts are done, John, attrition is still much lower than it had been. It's 50% over at Morgan Stanley of what it had been, which means it's not easy to find a new job necessarily as this activity starts to come back because the headcounts have swollen just so much, and there's still expense pressure on Wall Street. Good news for Goldman, the operating expenses without all of these costs would have actually been lower after those job cuts, which again, call that a bottom.
Shanali, thank you, and brilliant work as always this earnings season on the financials as we wrap up the numbers on Wall Street with Goldman. Goldman slightly negative around the opening bell. We're about 5 minutes into the session. We're negative there by 0.7%. Morgan Stanley just about unchanged. Goldman down about 0.8 as I speak, and back to 0.6. To Shanali's point, all over the place, just in negative territory below that zero line in the first 5 minutes of the session. I want to stick with earnings. Shares of Carvana surging at the open. The company topping earnings estimates and reaching a deal to restructure its debt, announcing plans to sell up to $1 billion of shares as well. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Carvana actually spooked Wall Street last night when it announced that it was going to move up its earnings release by several weeks. But turns out it was to announce pretty good news. Quarterly earnings beat forecast. And the reason why you're seeing shares up almost 41% at that moment is the agreement with the bondholders. It's going to eliminate about 83% of Carvana's 2025 and 2027 unsecured notes. All told, Carvana expects to reduce its debt load outstanding by more than $1.2 billion. And that's in addition to the stock sale that you mentioned. Now, Bloomberg Intelligence was out with some healthy caution this morning, writing that while this was a needed step, it's possible that further balance sheet restructuring will be needed for Carvana as the cash burn continues. But you're not seeing any of that caution in the shares this morning, currently up about 26%. For the year, John, Carvana is up more than 900%.
What do we call Carvana, Katie? Tech firm, auto dealer, what are they?
Right now, it's a comeback story. I'm not sure what you would call it in terms of what they do, but just astounding to watch this.
Every time I bring up that company, TK turns around to me and just says, what on earth does Carvana do? Katie, thank you. Carvana flying this morning by 29%. 6 or 7 minutes into the session, equities positive by 0.4%. The Nasdaq up by, let's call it 1/3%. Wall Street warming up to the rally in a big way. Jonathan Golub, Credit Suisse, the latest to raise his outlook for stocks, writing this: we are raising our price target on the S&P to 4,700. They were, by the way, at 4050. Their base case now is that a recession will be averted, inflation will remain sticky near current levels, and monetary policy will tighten only incrementally. Let's talk to someone else bullish on this equity market. Deutsche Bank's Binky Chada, 4,500 year-end price target. Binky, several months ago sounded bullish, not so much anymore. Binky, you were constructive and right. What do you see going right, going your way over the last few months?
So far, I would say, the most important thing that's happened, to repeat basically the obvious, is that inflation's come down. But I think that, you know, a very important aspect of that has really been, you know, really the opposite of the popular narrative, which is, you know, better growth is going to raise inflation. What we've really had basically since the peak in inflation in June last year is, as inflation has come down, real incomes have grown, and they've grown basically pretty solidly. So, you know, the trough, so to speak, in real incomes was in June of last year. We are now in the 13th month of, you know, what looks like pretty solid growth in real incomes. And so, you know, that is naturally basically pushing out the possibility basically of us, you know, running out of, the consumer running out of savings built up and the like, because if income is growing, then consumption is going to grow, and you don't really need those excess savings. So I'd say that's been the most important development. I think it's mostly gone below the radar because of, you know, this narrative focus on the Fed, that the Fed, you know, if growth does pick up, well, you know, growth's not necessarily endogenous, but we've had 13 months now of real income growth coming from declining inflation, or, you know, really a faster rate of growth, really, of real income. And I think that's been the game changer.
Well, Binky, you say it's gone under the radar, but arguably the market's picked up on it. The cruise lines, 3 of them are in the top 10 performance stocks on the S&P 500 this year. The airlines are doing tremendously well. My question would be, can things get even better for discretionary?
I think that they can. If you look at, you know, the cyclical parts of the consumer that are in consumer discretionary, I would say that's where, you know, the extreme and you know, relatively severe hard landing, I would say, had been priced in, and that's coming off. I would argue, you know, the same is true really of the financials, and that's the 2 places where, you know, in the event of a soft landing and, you know, if this period of basically declining inflation and better growth continues, that's where I would argue you want to be long. Yeah.
As you know, Binky, these companies live in a nominal world. Can you talk me through the relationship you'd expect just to the S&P 500 between disinflation and revenue growth?
Yeah, so, you know, we have a take that's relatively different. I would say basically, you know, we're not really concerned about what disinflation is going to do to earnings. I don't have this, you know, one-line sharp, you know, QED answer, but if you look back historically, if you look in the 1970s, for example, you know, and you look at a revenue growth, it was, you know, very strongly correlated and booming with inflation. But if you look at earnings and you try to see what is the relationship between the real growth and what is the relationship of earnings with inflation, they'll see that it's all really coming basically from real growth, such as, you know, so a good indicator would be ISM manufacturing, I would say. And what I would say is, you know, the correlation basically with inflation is essentially non-existent. And I'd say, you know, the answer is sort of complicated. The empirical evidence is basically pretty clear. But if you think about pricing relating basically to costs, and if you believe that that's going to be symmetric on the up and the downside, then the slowing should really not be an issue. The slowing in inflation should not really be an issue for earnings. Earnings is going to be really much more about real growth. Indeed, you know, as they were in the 1970s too.
So, Binky, let's put a bow on it. Your base case now, do you see the cyclicals taking a baton from what's happened with tech so far this year, or do they just rally in tandem? How are you thinking about that dynamic?
So we moved about 5 to 6 weeks ago to neutral from overweight on mega cap growth and tech coming into the year. You know, we expected a big positioning squeeze led really by the mega cap growth and tech stocks, and so the NASDAQ basically leading. That's happened basically, and I would say there's the squeeze. The squeeze was followed really by positive inflection basically in their earnings. But if you look at the price action, it has now far exceeded basically, what is expected out there in the future in terms of earnings and our own estimates. So I think it was a good time to move back down to neutral. And I would say since late May, mega cap growth and tech and the rest of the S&P 500 have basically been moving in tandem. So, the rally has basically widened out, but I would, keep that neutral rating basically on mega cap growth and tech. It's not a negative fundamental view. It's just a question of what's already basically in the price.
Binky, congratulations for the call so far this year. Constructive and right to be constructive in 2023 when others weren't. Binky Chadha there of Deutsche Bank. 13 minutes into the session, equities up by 0.4% on the S&P, on the Nasdaq up by 0.4%. Plenty of focus on tech a little bit later today. Coming up, Netflix kicking off tech earnings after the bout.
There's a lot of ways to look at the strike, but the bottom line is it actually makes them money not to make content. They can pare their costs. They can, get out of bad contracts and bad deals, and they can really focus on quality.
A conversation up next.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
There's a lot of always look at the strike, but the bottom line is it actually makes them money not to make content. They can pare their costs. They can, get out of bad contracts and bad deals, and they can really focus on quality. And since they're producing content all around the world, they just focus on their international content, which has been phenomenally good and has no effect from this strike. So in a global entertainment world that Netflix functions in, really these U.S. actors are really just making themselves sort of in a weaker position globally.
Big tech in focus. Netflix earnings after the closing bout. The Nasdaq 100 recording its best first half on record, leaving estimates in the dust. Shares soaring past analyst price targets this year. Netflix, Microsoft, Apple, and others as well. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what are you and the team looking for after the close?
Yeah, so there's a lot of bullishness, John, a lot of optimism going into this second quarter earnings. Obviously, the big number that everybody's looking for is subscriber gains. And really, this is a momentous quarter in many ways because this is the first time after their widespread password crackdown that they're reporting numbers. So it's going to be interesting to see how many new subscribers they did gain and what their guidance is for 3Q in terms of, revenue growth reacceleration. They're not going to give any subscriber guidance per se, but they will give some guidance on revenue growth as well as operating margins. So I think that's what the street is really going to be focused on.
And let's face it, the subs guidance was always awful anyway, based on where it came in relative to what happened. Geetha, thank you. Geetha Raghunathan of Bloomberg Intelligence. We're going to touch base with Geetha again tomorrow morning after the Netflix results a little bit later. Mixed opinion over what's going to happen with Netflix. Also the writer's strike, several things we need to think about. Loop Capital's Alan Gold joins us now for more. Alan, can we just start with the crackdown on passwords first, and then we'll get to the writer's strike and the catalogue over at Netflix too. What do you think the sub-story is going to look like? Are people going to be taking up more accounts, or are people just going to be cancelling?
Thanks. Good morning, John. So the crackdown on password sharing is probably the biggest fundamental change Netflix has done in years. The company did give guidance that 2Q would be about 1.8 million, said close to 1Q. The street is at 1.8 million. There was some data that came out by a company called Antenna saying signups had spiked after the password sharing crackdown on May 23rd. So we know the gross ads are up. We don't know how much the cancellations are up. I would say the buy side is looking for 3 to 5 million net ads for 2Q. They're looking for close to 5 million in 3Q. We'll figure that out from the revenue guidance, how close that is. And that's what's driving the stock, was just the successful rollout of password sharing crackdown.
Well, the stock's up big time by 61%. Alan, would you go as far as saying that most of that's discounted then, going into this print?
Yeah, we think the returns are asymmetric going into this print. The stock's up 40% since they reported, over 40% since they reported 3 months ago. So I think this is well discounted in the stock. Listen, Netflix is winning the streaming wars. They're going to benefit, as your prior guest had put on, from the strike. They are clearly in the lead position here, but the stock's had a heck of a run over the last few months.
Let's get to that strike. Alan, I was reading your research. Why are they best positioned to ride out this writer's strike compared to, say, other streaming companies?
Sure, two fundamental reasons. Number one, Netflix has more content in production. They just have more content about to come out. So if everyone had to halt content over the next few months, Netflix would have more new content than anybody else. Secondly, Netflix is a global producer. So if the U.S. writers and screen actors are on strike, they can still be producing elsewhere. The biggest show in Netflix history was Squid Games, a Korean show.
Alan, just a final one from you then. Kind of on that, the difficulty that other streaming providers, other companies are having, not just making content, but having the money to make content. Netflix is making money. Others have been chasing subs and they've had to pull back. Alan, you said they're winning. I just wonder how you think that dynamic's going to carry out in the quarters, the years to come. Because you say Netflix has a better catalog. That might be just because they're in a position now to be able to make the content. They have the money to do so. Are there others in a decent position with a strike or without a strike?
Yeah, I mean, listen, this year Netflix on an EBITDA basis will make about $7.5 billion. And the four largest traditional studios will probably lose $7.5 billion combined in streaming. So they're clearly winning right now. Listen, Disney's got a phenomenal library, phenomenal content. All the other streamers are raising price. I think their pricing was too low. But Netflix is the clear winner. And we just don't know. Amazon will be big in this business. They're spending a ton of money. You never know where Apple's going to do. But yeah, I think we have to have consolidation of the other streamers. And you'll probably end up with three or four large streaming companies. So there'll be some consolidation. Pricing will be raised by the others, and marketing costs will come down, and they'll eventually turn profitable. But Netflix clearly has the lead and will be the long-term winner.
Alan, you say consolidation. Who's getting married? What kind of tie-ups are you looking for?
Well, Paramount to me is the most obvious one. It's relatively highly levered. They're losing a fair amount of money. This is supposed to be the peak year of losses. Management hasn't given us any indication when they turn profitable. I could see Paramount tying up with someone, or at least their streaming business. Yeah, at Comcast, they're losing $3 billion this year. At Peacock, again, it's supposed to be the peak loss. Interestingly, Paramount and Comcast, or NBC Universal, have a joint venture in Europe called Sky Showtime. I could see something like that here. HBO Max, they've got great content, or Max as they're now calling it, great content, but they're pretty heavily levered. They're going to have to figure out how to, they have turned profitable, they say, in streaming, but they're going to have to get a lot more profitable given their debt load.
Alan, thank you, sir. Great to catch up going into that print. Alan Gould there of Loop Capital on Netflix after the close. Coming up, your trading diary with equities right now positive 0.4% from New York. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
26 minutes into the session, stocks higher on the S&P for a third consecutive day. That's the price action. Here's the trading diary. Coming up a little bit later, President Biden discussing consumer protections at 3 p.m. Eastern Time. Netflix and Tesla report after the bell. Head of American Airlines and regional banks, including Truist and Fifth Third, tomorrow. We also got another round of jobless claims, plus existing home sales, and more earnings Friday, including American Express. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming live on that YouTube thing. Just head over to YouTube and search Bloomberg Global News, and you'll get the video to go along with the audio there. Got some green on the screen here. Coming up, we're going to check in with Allison Williams. She's a senior banks analyst at Bloomberg Intelligence. She's busy yet again today. Goldman Sachs reported some numbers, a little bit disappointing. We'll break it down with Allison. Erica Edelberg from Bloomberg Intelligence talked to us about the mortgage market, mortgage-backed securities. Mortgage rates are going higher yet again. What does that mean? And Michael Sonnefeld's going to check in with us. Michael works with ultra-wealthy investors. He gives us some good perspective on where some of those folks are allocating their capital these days. So that's always a good discussion. But first, we're going to kick things off with John Tucker. Get a Bloomberg Business Flash.
Yeah, and good morning to the major averages. They are adding to their gains this morning, and this comes despite those disappointing results from Goldman Sachs. Goldman, the worst performing stock right now in the Dow Jones Industrial Average. Part of this is also a rate story behind the rise in stocks. We had better than expected inflation numbers out of the UK this morning. That adds to this chorus of maybe we've reached peak rates. Right now in the S&P 500, you have 9 of the 11 major industry groups. They were in the green. Real estate leading the way. You had data this morning showing builders working to fill the void left by a lean housing inventory. Well, the Fed still in the driver's seat for a lot of market participants. This according to Anna Hahn at Wells Fargo Securities.
Things are cooling a bit, but if the Fed is able to give us that Goldilocks, almost that Powell put in terms of not just equities, but really economic consumer spending, then that's a kind of a happy scenario for a lot of people.
Right now, the S&P 500, 20 points higher. That's up 0.4%.
45.74 in the index. Dow Jones Industrial Average of 193 points. That's a rise of 0.6%. The Nasdaq 138 points higher, up 0.25% right now. Among some of the other earnings reports we're going to get after the close of regular trading today in New York, Tesla reporting. Investors are going to be looking for more details on the Cybertruck. Also, they want to know how a series of price cuts cut into margins at the company. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and I can't see, so I don't know.
Madison.
Maddie.
Hey, JT. How could you miss me?
I suppose a giant column in my way.
That is true.
we kind of seclude John Tucker there. All right, Madison, we got some green on the screen here today. So another lift to the tape here. We're going to break down some earnings. Goldman had some numbers. We'll talk to Allison Williams coming up on that. But another strong day here in the marketplace.
Yeah, definitely. And I'm really excited because we have a fantastic equities reporter in for us. And I'm just looking at her story just crossing the terminal a couple of minutes ago on why U.S. stocks are looking past the earnings recession. So one of the many calls that we're going to be able to chat with her about.
All right, great stuff. Let's check in on those markets here. Again, the S&P up about 0.5%. We'll do that today with Bloomberg equities reporter Alexandra Semenova. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at this morning?
So it's so great to be here with you this morning. Of course, the big story today is earnings results from Goldman Sachs, reporting one of their weakest quarters under CEO David Solomon. Earnings at the Wall Street mega bank fell 58% on a slump in deal-making activity, real estate markdowns, and a goodwill write-down on its struggling consumer business. A return on equity, which is also a key measure of profitability, slid 4% in the quarter, which is the worst among the top banks that reported. So the stock is down. However, when you look at the big banks more broadly, they've really reported quite solid results, which has been a reassuring start to the earnings season, helping lift the broader market. We've seen gains in recent trading sessions, and it's really been powered by these earnings reports that have come in much better than expected when so many people were kind of bracing for doom and gloom, this earnings recession that everyone is talking about, and of course better than expected inflation data. We're certainly seeing a change in the narrative around a soft landing. Goldman Sachs downwardly revised its recession expectations.
Yeah.
You have JP Morgan Chase & Co. Marco Kolanovic, which has been warning that, stay away from stocks because there's going to be a recession, softening his tune earlier this week, saying that the narrow path to a soft landing is starting to look a little bit wider after, the CPI print that we just got. So really, really a big change in what investors are seeing for the rest of the year.
Yeah, and I just want to read out this redhead we're getting on Carvana, filing to sell 35 million shares, seeing proceeds of at least $350 million there. Alex, talk us through the Carvana story this morning, the only story as important as the bank earnings that we're getting in.
Well, this is one of the boom and bust stocks of the pandemic, so everyone's really paying close attention to this reversal that we're seeing in Carvana. The last time I checked my terminal, shares were up about 30%, although lots of movement this morning.
Yeah.
Pre-market, it rose as much as 50%, and so it said that it reached a deal to restructure its debt. It also filed to sell as much as $1 billion worth of shares. It's been struggling to pay down its sizable debt, and with a correction in used car prices, sending its market value plunging about 90% from its peak 2 years ago. And last week, analysts at JP Morgan Chase said that Carvana has managed to materially slow cash burn by cutting costs and taking advantage of resilient used car prices. It did, however, downgrade the stock and say that it needed to sell shares to pay down its debt, which is what it announced this morning, which is why it is getting such a positive reaction today.
Yeah.
Well, I'm just looking at the GP, the graph, this stock price, going back to the beginning. I mean, back in August of 2021, $360 a share. It got down to a couple of dollars a share just, in late 2022. So it is up almost 1,000% this year. But again, its peak was $360 a share, so it's got some more work to do, I would say, from that perspective.
It's always quite remarkable when you look at these pandemic stocks and kind of compare the charts. They all look quite similar, where you see this meteoric rise and then they all fall, and they're kind of seeing a rebound this year as people get excited about rates possibly coming down.
Yeah, well, also meme stocks in general are starting to get a little bit more attention, which we'll have to talk to Bailey about the next time he comes in. I know he'll be very excited about that. But that doesn't necessarily... that feels like a negative sign to me, because you taught me this, Alex, that once the retail investors are getting in on something, it's usually a contrarian indicator.
It could be a contrarian indicator, but we're not. That's not the case in this market. It seems like investors feel really, there's a lot of reassurance about where stocks will go for the rest of the year. We have inflation coming down. We have recession forecasts coming down. A lot of Wall Street strategists are upwardly revising their targets. Credit Suisse was the latest firm yesterday. Jonathan Golub, the chief U.S. equity strategist there, revised his year-end target to 4,700 from 4,050. So it's a sign that there's this, catch-up as we get into the second half of the year, and so many people missed out on a rally that they didn't see coming.
That's what I think is going to be interesting, just to see the average PM out there who sits back and says, boy, the market's, was up 15% in the first half, up another 3 or 4% here in July. I got to get moving here. I can't, head into the third and fourth quarter so far behind the market. I got to catch up. I wonder how big of a thing that is, but maybe that we'll see that in the broadening out of some of the market away from the Magnificent Seven stocks to maybe some broader categories.
Absolutely. There is a lot of talk about the equal weight S&P 500 index kind of set to perform better than the cap weighted index, because we've already seen such a stretch in those Magnificent Seven names. We could see a mean reversion and see some of the laggards catch up. So that's an expectation among a lot of people this year as well.
Okay, very good. Alexandra, thanks so much for joining us. Alexandra Semenova, she is the equities reporter for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Carvana, definitely a big name. Also, our good friends at Goldman Sachs, kind of a tough quarter. I don't feel sorry for them because they win a lot more than they don't. I competed against them for many years with some success, but always tough competitors everywhere you go. Somebody's also followed this company for a long time. Allison Williams, Bloomberg Intelligence. She's her senior banks analyst. And you know what? She's also a suit. She's now management. She runs the U.S. business for Bloomberg Intelligence. So it's like, now she's a suit. She's a boss.
You're a boss now.
Yeah. Exactly.
You were a boss before.
Paul only says that because I have tough shoes to fill.
Exactly. So, Allison, I don't know. Talk to us about Goldman Sachs here. It feels like they kind of got a little bit off track with that retail push, and maybe that took some attention away from some of their businesses. Yes, it is a tough environment, but Goldman Sachs is still Goldman Sachs, right?
They are, and you're seeing the other side of volatility to some extent, right? So, I mean, the ROE is very tough this quarter. Includes a lot of one-timers. There's some charges. There's, they're working towards a longer-term strategy, and I think they're doing the right things. The alternative strategy, you're really showing this quarter why that they're implementing that in terms of moving to a model that's more focused on fees and managing assets for clients versus taking the risks directly on their balance sheet, which is something that regulators have wanted them to move away from for a long time. So they had that charge. They also had the charge related to Green Sky, offset by a little small gain related to some sale of Marcus loans. I think, moving away from those businesses also strategically the right thing for Goldman. Focus on what you're good at. Unfortunately, it's a tough quarter for the business, but equities trading up 1%. I mean, that's impressive in this quarter.
Yeah.
And that's, it's a prime brokerage business, and that shows that they're executing on what they do well.
So when it comes to the consumer business and Green Sky, like you mentioned, is part of what we're seeing right now with Goldman just some pain that they have to go through to kind of have this transition out of and away from those two things?
Yeah, I mean, in general, when you shift strategy and do some kind of restructuring, first of all, it's never in a straight line, and there's always charges before you sort of move on to the better stuff, because they were performing well, you probably were not. Businesses that you're getting rid of. Right. So it's tough for them to take the impairment. It shows that was not an asset purchased well. Yeah. But I think that on the cost side of things, if we strip out these costs, there still is a little bit more work to do. Mm-hmm. So they do, they want to get to a 60% cost ratio over the cycle. They're at about 70% once you make all the adjustments. So part of that is the tougher part of the cycle. So I talked about equity trading, which was a real positive. FICC trading was weak as expected. Goldman and Morgan Stanley especially, you're seeing big declines because they had such good quarters a year ago due to commodities. And on the banking side, Goldman is the M&A revenue leader, as you know, Paul, from competing with them in the past. So they, the league tables move around, but that's a big chunk for them, and that's just going the wrong way right now for the industry. We're hearing a lot of constructive comments about the pickup there. And you've also mentioned from some folks hearing some positive comments, but those are really not going to play out in the second half. That's a 2024 story.
All right, let's step back and just talk regulation, not so much for Goldman per se, but just for the banks. All right, post-financial crisis, a lot of new regulations came on the industry. Fine, we get it. There had to be some response and probably well-deserved regulations. I would have thought, and over time, a lot of those regulations would just kind of fall to the wayside, peel back. But now the discussion is actually even for more regulations. What is driving that need for more regulation of the banks? I know Jamie Dimon's been a big spokesperson kind of against that, along with Brian Moynihan, Bank of America.
So there's two things. First, which is on the quote smaller banks, but not the biggest banks that I cover, right? So we had the issues in March that did raise a lot of questions of, some of the things that were rolled back. Should they have been? And so I think that sort of, to your point, things started to roll back, but now the question was was that the right thing to do? The second part that's more germane to the banks that I cover, which is Basel III Endgame, which we hope is finally the end. So again, we've had all these regulations over the years. There's some still finalization that we're expecting any day now for the last few weeks. And I think that why you're hearing the bank managements complain is that, first of all, the way that the Basel works, because you hear this term a lot, right? So Basel is really an entity that sort of sets the guidelines, and then the jurisdictions go out and implement those. So the U.S. has a lot of other very strict regulations that other countries don't have, right? So we have the stress test every year. That adds a lot of volatility, and that really is very punitive to the trading books of banks. This Basel III Endgame, again, supposedly from what we've heard from the proposal outlines, is also going to be tough on the trading books of banks. So do you really need to have this sort of double whammy and these different types of conflicting regulations that, really make it very difficult? And I think, what the bank managements will say is you might make the banks safer, but the risks will still be there and they'll be outside of the system. And is that really what you want? Unintended consequences.
Because that goes to a business that Maddie and I talk about a lot, which is the private credit business. And these private creditors come in with almost these Cheshire smiles. They're like, I can't believe how good it is for us now because the banks have so much regulation that they're reluctant to put some of these loans on their books. And so the borrowers, big private equity shops, are coming to us, and we're making money hand over fist here.
And if you looked at a very long-term chart of banks, since the crisis, you will see the huge growth of credit in the non-bank sector, shadow bank, whatever you want to call it. Private credit is certainly a huge player there, and then the decrease on banks' balance sheets. But again, these private credit firms are getting they're raising capital, from someone. And if you think about it, the private credit is really sort of the talk of the entire asset management industry. Even the traditional managers buying into private credit, the private equity managers building up their private credit businesses. So you have all this money going there. There's more talk about getting this into pension portfolios and other portfolios. So you can think about sort of where the risks and who's going to bear those risks and how that's all shaping up.
I'm thinking about going into the private credit. See, I went through the Chase Manhattan Bank credit training, which is the best on Wall Street back in the day. I can take those skills and go to private credit.
There you go.
I should have done it. I mean, there's still time for me, you guys. I can get an MBA tomorrow. Allison, I want to ask you a weird one in our final minute and a half with you. A lot of my friends got the Apple savings card with Goldman. What do I need to tell them? Are they going to get ditched by Goldman any day now? What's going on with that?
I mean, they probably don't even know that Goldman's involved, except that you probably told them that. And that's why those cards are generally called private label. So what Goldman had said, right, was that they were getting away from Marcus. They did keep the GM relationship, the Apple relationship, where there's some kind of a relationship. But in general, when those relationships fall apart, it tends to be because the economics just aren't working for one, or someone else is coming in and willing to accept lower economics. So, and of course, we never know that, or most of us never know exactly what happens. But, that could be the case that someone's coming in and just, more interested in the credit card business and now that it's not so strategically important for Goldman, you know, will they be willing to sort of give that away? And it's also been interesting, right? So the other side of it is the deposit gathering business, and you see Apple's introducing this new product, but then you have the Marcus product, and you see the yields on both of those and kind of competing. And you know, where would Goldman like those? They obviously would like to get 100% of the economics where they can.
Right.
Okay, thank
All right,
you
Allison.
for that.
Thanks so much for joining us. I know this is a busy few days for you. Allison Williams, she covers all the banks on a global basis for Bloomberg Intelligence. She's also the Director of Research for the U.S. business for Bloomberg Intelligence. So we appreciate getting some of her time here in the Bloomberg Interactive Broker Studio. Stocks, S&P, up 0.4%. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, the deadline to complete the biggest video game deal ever gets extended. Bloomberg's Gina Cervetti reports.
Steve, Activision Blizzard agreed to give Microsoft 3 more months to close their $69 billion merger so the companies can iron out remaining regulatory concerns. The agreement was set to expire last night at 11:59 Pacific time. Now the companies will have until October 18th to get it done, according to a regulatory filing. The parties also increased the amount of a breakup fee Microsoft will pay to Activision if either side terminates the deal, but both have said they don't plan to walk away and will continue to seek regulatory approval. Steve?
Thanks, Gina. Carvana stock surges more than 25% after the company announced a deal to restructure debt and filed to sell as much as $1 billion worth of shares. More from Bloomberg's Charlie Pellet.
Steve, the used car retailer is trying to regain its footing following a pandemic boom and bust. Carvana expects to reduce its total debt outstanding by more than $1.2 billion. The moves are breakthroughs in Carvana's efforts to get a handle on its debilitating debt load following an ill-fated expansion during the pandemic. Carvana also reported better-than-expected quarterly earnings, beating estimates with a $105 million net loss. Steve?
Thanks, Charlie. And despite all the talk of excessive job cuts coming down at Credit Suisse, at least one area is growing. Sources tell us the bank is looking to expand the collateral loan obligation team in its asset management unit. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen today. Data out of the UK, interestingly enough, setting part of the tone for the markets today. The inflation data there, that was better than expected. So that has investors thinking at this point, maybe we've hit a peak in inflation as well as rates, and that, of course, is good for risk assets. Despite lame results from Goldman Sachs earnings, the major averages all higher. Some more data. Housing starts running generally above pre-pandemic levels. And looking ahead, you had permits to build new single-family homes that rose to a one-year high. Best performing stock in the S&P 500 right now, Northern Trust. That's up close to 9%. Also, AT&T, that is 8% higher. And after the bell, we're going to get results from Netflix. So the hope there, after the close of regular trading in New York today, is that maybe since they cut off a lot of people who were, logging on to Netflix with bogus like me.
Well,
but I didn't sign up. I didn't go and then sign up for Netflix. I just did without it.
I think some of the Sweeney offspring are facing some harsh realities.
So that's sure to show up.
Yep.
Very harsh realities. I
tonight.
can't wait to hear them make fun of my family specifically. We were very impacted by the password sharing. Yeah.
We're all cheaters. S&P 500, 21 points higher. The Dow up 277. The NASDAQ 100 right now 21 points higher. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Maddie and Paul.
All right, John Tucker, thank you so much. We appreciate that. Madison, when I bought the Jersey Shore compound earlier this year, my mortgage had a 6 handle on it, and I was not happy. Just got rooked at because I know Matt Miller's is, I think, sub 3 on his estate up in Westchester. But I'm looking at the bankrate.com U.S. home mortgage 30-year fixed national average today. 7.15%, so maybe I'm not that dumb of a buyer, but anywho, where are mortgage rates going? What's going on in that market? I have no idea, other than we call Erica Edelberg. She's an MBS strategist. That's mortgage-backed securities for you out there. For Bloomberg Intelligence, she joins us here in our Bloomberg Interactive Broker studio. So, Erica, how are mortgage-backed securities, how's the market in 2023 so far year to date?
Hi, thanks for having me on. The market is actually just barely up, I think, on an excess return basis.
Yep.
We actually have rates are up 100, as you pointed out. They're up about 100 basis points in terms of primary mortgage rates year over year, but they are off their recent peaks. So at least you didn't take out a 7.35% mortgage last week or so. As they rates had fled higher once again when non-farm payrolls came in a little stronger than some people had hoped or expected, but there has been some retreat in that again with CPI coming in a little bit lower. So we're still closer to the highs than the lows, but we are off the tippy top. But anytime you have mortgage rates around or above 7%, it probably is restrictive on an affordability basis for quite a few people.
Yeah, well, it's really interesting. I know that you know all about this, but this Redfin report was fascinating to me, showing that just 1% of the nation's homes have changed hands this year. And they also have data showing that 90% of Americans do have a mortgage under 6%. So why would anyone ever be incentivized to let that go when, like you said, Paul, now we're at the 7 handle? What could be the catalyst for people to start to say it's time to leave behind my home and get a new mortgage?
I mean, to state the obvious, life happens. People have kids. There's divorces. There's so over time, and I mean, if you look at the very long range average, it's not like 7% is it's high, but we've had rates a lot higher. It seems like all of our older siblings or parents, depending on what generation we're in, at one point probably had rates that were 7 to 10% or even higher. Of course, all those people have now refinanced to 2.5% if they still have mortgages. But
is that the move then for people listening? Just if you are waiting to buy a home, don't wait, just do it now and refinance?
That's certainly what a new home builder would tell you.
Yeah.
and new home builders are, that's really the game in town right now, because as you just mentioned, except for the people who do have to move for one reason or another, very few people are listing their homes. The numbers on listings are extremely low. So the resale market, as they call it, or existing home market is very slow. But new home builders, as John just alluded to, permits and starts are up. New home sales, new home inventories are about a third of existing homes, of homes listed for sale these days. And the new home builders are finding ways to incentivize first-time home buyers and even some move-up buyers by offering them slightly lower rates. what's interesting, I was reading just the other day that some of these buy downs, as they call it, were relatively temporary. They offered like a 3-2-1 buy down, where it's basically only good for 3 years. The first year they buy down the rate for 3 years, then 2, then 1. They have to qualify them at the higher mortgage rate, so unlikely to be another subprime teaser mortgage rate. But it might come as a rate shock. Maybe some people had expected, as you mentioned, rates to fall sooner and to be able to refinance to that time, and that's what the home builders are selling. They're like, for right now, we'll give you a lower rate. Surely you'll be able to refi in a year or two. Some of those people certainly haven't been able to.
Yeah, I kind of thought, I gave myself 12 months, which I still have plenty of time, that I'd refinance with a 4 handle. And I'm not sure that's going to happen, but we'll see. But I will refinance low. I'm not too concerned about that. All right, so talk to us about, I think about office space. And in some of the biggest cities, there's so much office space. And people are telling us that's going to be a real problem for the lenders and so on and so forth. How does that impact your market, the mortgage-backed securities market?
I think the actual office space, there's 2 ways it could impact it. For one thing, as we've just mentioned, there is a bit of a lack of availability of homes for sale for those who do want to get into the market. New home builders are picking up, but actually, if you look at the charts of permits and starts, we're a lot higher than we were in pre-pandemic levels, but that's because there had been 10 years post-financial crisis of underbuilding. So there's a big trough after 2009, 2008, and it was just creeping slowly up and then shot up during the pandemic. So we're about 20% below pandemic levels. We're well above where we were in the 10 years beforehand. But what that means, that's the other reason there are so few homes being listed. Not only are people locked into their mortgages, but honestly, there was probably a structural underbuilding of new homes to begin with. So some of the people have talked about converting some of this office space into residential loans.
That's my dream.
Residential homes, which could offer more opportunities. But from a macro perspective, loans that were made to office spaces that are now falling in price, maybe even underwater, those have to be refinanced or reconstructed on a more regular basis. And that could be a drag for lenders, which whenever you have a drag in the banking industry, can be a drag generally for the economy.
Is the decrease in construction costs and kind of the alleviation of some of the deeper supply chain issues of the pandemic having an impact on home builders that will ever get passed on to home buyers?
Yeah, actually, in some ways it already is.
Okay.
If you look at the difference between the median new home price and the median existing home price, because existing home prices haven't fallen maybe as quickly as some would have expected given the lack of listing, the difference between those is almost a record tight. Like new homes are normally more expensive.
Right.
But right now they're just very marginally more expensive. So I think some of that, whether it's through price concessions, which actually builders say they're not really offering as much anymore, or just costs coming down relative to what they had been, I think that already is manifesting itself. And some people have I've read some people even calling for new homes to be priced below existing homes. And again, this is all median prices, so this is not adjusted for square footage or anything, but it's an interesting, potential.
ESG, environmental, social governance, is that kind of a part of the mortgage lending market as well?
It is interesting. I put out a note yesterday that you may have seen, might be referring to. And first of all, in terms of Ginnie Mae mortgages, those backed by FHA, for instance, in some ways those were already fundamentally ESG loans because they're targeted towards trying to improve affordability for lower income and higher LTV borrowers. Now, Fannie and Freddie have also started to highlight their efforts. They've always had a little bit of a mandate there anyway, and their duty to serve. But they have these new social criteria scores and social density scores that they're publishing that are available here on the terminal that tell you just how many of these socially responsible criteria they're fitting. And in the research that we put out yesterday, we pointed out that some of these highest social responsibility loans are actually in some ways offer the best risk-reward characteristics because a lot of these homeowners are a little more restricted from refinancing, but at the same time, they may have more incentive to be move-up borrowers, for instance, so they tend to have less extension risk too.
All right, interesting stuff. Always talking about the housing market, the mortgage market. Everybody has their thoughts and opinions. Erica Edelberg, we could pay her to have those opinions and that analysis. Erica Edelberg, she's a mortgage-backed security strategist for Bloomberg Intelligence, joining us here in our Bloomberg Interactive broker studio. Again, that the bankrate.com average mortgage rate for 30-year mortgage, 7.15%. It's off the highs, as Erica was just mentioning, but certainly a lot higher than a lot of people want to deal with. And the question is, to what extent and when will that come down? Looking at the markets here, a quick snapshot. S&P 500 up 0.4%. NASDAQ giving you up 0.25%. The Russell also up 0.5%. So some good movement there in the early trading on these markets. Right now, let's head down to Washington, D.C. We'll get World and National News with Nathan Hager.
Bit of breaking news to start things off, Paul. Good morning. Legacy admissions are coming to an end at Wesleyan University. The New York Times just reported that the Liberal Arts College in Connecticut is going to end preferential treatment for children of alumni. This follows the Supreme Court's decision just weeks ago to end affirmative action in college admissions decisions. Several other highly selective universities have already dropped legacies. They include MIT, Johns Hopkins, and Carnegie Mellon universities. There will be no new trial for former President Donald Trump in the E. Jean Carroll case. A federal judge rejected Trump's bid to overturn the $5 million jury award for the magazine columnist who says he sexually assaulted her in the 90s and then defamed her for saying she lied about it. U.S. District Judge Lewis Kaplan says Trump's claims of the damages were excessive, were, quote, entirely unpersuasive. That American soldier being held in North Korea was apparently trying to escape an assault charge in the South. A U.S. official tells Bloomberg News Private Second Class Travis King had just been released from detention in South Korea, was set for a flight to Fort Bliss, Texas, where he was going to be formally separated from the U.S. military when he skipped the airport and joined a private tour of a Korean border village. Sarah Leslie was in that tour group. She's from New Zealand.
US and South Korean soldiers sort of realised what was happening, chased after him, yelled at us to sort of get in the building on the South Korean side. So we all ran in after that. But they didn't catch him. We were pretty close to the border, and it would have been pretty hard to stop him.
Sarah Leslie spoke there with CBS News. The heat is on and doesn't look like it's going anywhere anytime soon. The latest long-term outlooks from the U.S. Climate Prediction Center have above normal temperatures for the lower 48 for the rest of this month. Phoenix is aiming for 20 straight days above 110 degrees. In the average year, it gets 21. And it hasn't gotten below 90 in Phoenix for the last 9 nights. That, too, is a record. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, stocks here in the U.S., they are plowing higher even after Goldman failed to beat the talk-down expectations in their earnings release this morning. At PNC Asset Management, Amanda Gotti is following the second quarter earnings results.
It's very early innings in this earnings season, but so far we've seen better than expected results. So I'm not sure if that sets the tone when we shift to other parts of the market, but so far results have been hanging in there okay.
So a big part of the story today for risk assets is the idea that rates may have peaked. This comes after that better than expected inflation report in the UK this morning. And after the close of regular trading today, we're going to get results from Tesla as well as Netflix. And the Mortgage Bankers Association says loan rates, they dropped below 7% last week. Rate on a 30-year fixed declining 20 basis points, 6.87%. S&P 500, 18 points higher. That's up 0.4%. 45.73 on the index. The Dow up 192 points. And the NASDAQ 151 points higher. That's up 0.3%. 2-year yield is down 1 basis point. We're at 474. The 10-year, 378. That's pretty much unchanged. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Madison and Paul.
All right, John Tucker, thank you so much. As always, we appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. Streaming, of course, all that good stuff on YouTube. Go to YouTube and just you go out there and search Bloomberg Global Markets. You know, every once in a while, we like to get a sense of kind of where high net worth investors are putting their capital these days. And to do that, we check in with Michael Sonnenfeld. He's the chairman and founder of Tiger 21. Tiger 21 is a network of learning groups for high net worth investors. We usually get some really interesting perspective from Michael. So Michael, again, the first half of the year was a lot better for most investors than 2022, where you really had nowhere to hide last year, whether it was equities or fixed income. Maybe some of your alternative investments did better. What are your members saying today? How did they feel here in mid-July after what was a pretty good first half of the year?
Nice to see you guys. And you know, our members are mixed, like the reports that you've been sharing all morning. On the one hand, inflation is coming down, the business climate is good, unemployment is low, but everybody thinks that we're sort of at the crest, or many people think we're at the crest, and at least half of our members think we're going into recession. And when you have this kind of diversity, our members try and create something like an all-weather portfolio where they have some bets on the upside and protection on the downside. And that's sort of been the magic quest that they're looking for in preserving their wealth.
Part of the flows into the S&P, obviously related to the Magnificent Seven, are related to the AI rally. I wonder to what extent your clients experience FOMO when something like an AI rally is happening, or are they kind of immune to that?
So I just have to say, we don't have clients, we only have members. These are all entrepreneurs who have no problem. These are all people who built great businesses and now are preserving wealth. But I don't think it's so much FOMO, because our members have been playing AI. Over 56% of our members either have or intend to make AI investment plays. And one of the things that's really different about AI, if you think about recent fads, either in crypto or the web 20 years ago, when you had these technology plays, you didn't have the equivalent of a Microsoft, which is already a cash flowing company, also be the technology play. If you want to play AI, of course, there's lots of small venture capital opportunities, but the best opportunities, many of our members think, are in like the Microsoft and the Googles that have the largest AI treasure troves, and yet they're really solid businesses. So it's a unique moment in AI that this kind of fad, I don't mean that it's unimportant, I mean this flavor of what everybody is focused on, you're not taking the kind of extraordinary risks that most other technology rallies require, because here you have companies that have real profits and real businesses, and real futures, no matter what happens on AI, but it'll be really enhanced as they roll out and continue to build their AI functions.
Hey, Michael, how about alternative investments? I mean, your members, they sell oftentimes their businesses for tens or hundreds of millions of dollars, and then they really have to allocate capital across a portfolio. How is investing in alternative investments, whether it's hedge funds or private equity or private credit, how's that changed over the last decade for your members?
So the two biggest changes, the single biggest is that private equity 15 years ago was about 10% of our members' portfolios. Today, our members manage $150 billion, and private equity is just about 30%.
Wow.
That's been the biggest change, and a big portion of that private equity is venture capital, because a period of time ago, you wouldn't have even seen venture capital 15 years, and now we think that's the largest subsegment of private equity. But on the other side, more recently, the biggest downshift we've ever seen is in real estate. Real estate was king for 15 years, bouncing between 27 and 30%. And in the last year, it came down quite precipitously to around 22%. And, our members are exquisitely sensitive to interest rates. And as interest rates are going up, that takes some of the potential off the table for real estate. But as your last speaker was mentioning, office, which was one of the most solid areas in the real estate area, is now up for grabs. A lot of problems, not just with vacancies, but where offices were easy to lever. And so as buildings, they probably are more highly levered, and the equity is more at risk. And behind that, on the negative, would be retail, and on the positive side would be industrial. But the office, where the office is going is one of the great conundrums that we'll only figure out over the next decade.
Well, that's one of the things I find interesting about these member feedback results you sent us, is that you asked about their most favorite public equity sectors, and they're tied. 24% said real estate and 24% said IT. I'm fascinated that real estate is getting as much love as the IT space, given the big tech rally that we've seen this year. Can you help me make sense of that?
Sure. Our members are, by accomplishment, about 1 in 10,000, equivalent to being in the major league. And the largest area our members created wealth in, maybe a quarter of our members, was in real estate. So you have extraordinary knowledge that most investors don't have. That's the advantage of being in one of our groups and being with somebody who built their career in real estate. So my guess is that real estate has been beaten up in certain areas, and our members are a little more attuned. The big question we ask in a meeting is, if you buy something at 20 and it goes down to 15, should you get out? And the answer is, if you really knew what you were investing at 20 and it goes down to 15, it's a better deal. But as I think you guys well know, over the history of the stock market, individual investors have never matched the returns, because they buy at the wrong time and sell at the wrong time. And so I think the high interest in real estate opportunities shows the sort of expertise that our members has looking for deals and navigating in this volatile climate.
Hey, Michael, real quick, just give us the latest on kind of estate planning. What are your members kind of focused on these days?
Well, first of all, there's a big date coming up at the end of 2025 where some of the major estate planning tools will sunset. But, I think our members are focused on the tension between giving kids too much and ruining essentially what they saw was their entrepreneurial ability to be successful. Right. So this notion of trying to figure out what to do and how much to leave. So, there's something called the giving pledge among billionaires, where they commit half of their money to foundation and philanthropy. And a lot of our members are thinking about philanthropy in a new way, particularly with all the problems that are in the world today.
All right, Michael, thank you so much for joining us. Always a unique perspective there. Michael Sonnenfeld, he's the chairman and founder of Tiger 21, a kind of collection of high net worth individuals, get a really interesting perspective how they allocate capital across the sectors. All right, right now let's get some company news with Steve Rappaport.
Paul, shares of Goldman Sachs are swinging this morning after the bank's profit plunged in the second quarter. Earnings fell 58% on an investment banking slump. Bloomberg's Shonali Bassick reports.
Everyone's calling it the kitchen sink quarter. This was a little bit expected here, but these write-downs are significant. Without them, they would have had an ROE north of 9%. But because they are here, it is worth addressing whether we'll see these kinds of losses again. Some of the consumer business won't take the same kinds of losses. This now becomes a story of what does the second half of the year look like. The pipelines are building when it comes to advisory, according to Goldman Sachs. And do the markets businesses also start to roar back?
Thanks, Shonali. Shares of Goldman Sachs currently up 1.5%. Johnson & Johnson is ordered to pay nearly $19 million to a California man who blamed the company's talcum-based powders for giving him cancer. Bloomberg's Jeff Bellinger has more.
Steve, a jury in Oakland concluded J&J's baby powder helped cause Anthony Hernandez Valdez's cancer. The company plans to appeal, arguing critical facts were left out because of erroneous rulings by the judge. A court order put all litigation on hold after J&J sought to wall off its talcum liability in a Chapter 11 bankruptcy. Valdez's case was cleared for trial due to his failing health.
Thanks, Jeff. Activision Blizzard has agreed to give Microsoft 3 more months to close their $69 billion merger so the companies can iron out remaining regulatory concerns. Microsoft and Activision Blizzard stock are both in the red at this hour. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up.